So, financial economics. So, what is economics? Before we get into financial economics, anyone can tell me what is economics?
Distribution of goods and services,
Okay, yeah, that's correct. Any
and
other?
then
Yep.
supply and demand takes place eventually.
Okay, supply, demand, goods and services. Okay,
That's where the market.
Management of limited resources.
okay, yeah, correct. Yeah, I guess you have broadly covered, what is economics. So basically, it's about scarcity, right? And how you make choices, and in the face of scarcity, and that, kind of uh, motivates your behavior. But what we are interested is not in economics, but in financial economics, right? I mean, this course is about finance. So what is financial economics then? Anyone?
How we manage our finances.
How we manage our finances? Okay.
Maybe it resembles on the same ground that allocation of our funds in the best possible way. Maybe what
Yep.
economists try to do in the sense of macro level, we might
Correct.
be able to just so it's just using. Thank you.
Correct. So financial economics is more about, how you utilize your fund for all the given, investment avenues. That is, one way of looking at it. This can be, at individual level or at institution level. Most of us are, typically focused on individual level unless you are working for a profile which, kind of directly has implications in terms of the investment allocation. But I believe most of us are not from those areas. So what we always think of financial economics is from our own, investment point of view, that how should we allocate our savings so that you grow your asset for your future retirement or your future financial goal. But most of the financial economics also talks about how institutions do that. And this is not just about investing, but also about risk management as well. So I guess, more than investment and return, I think it's the management of risk is of utmost importance. The returns would typically follow if you are able to, manage your risk appropriately. And this also kind of utilize the macro and micro economics concept. Now, as I said, you want to basically invest. And when you want to invest, you want to buy something which is, cheap and sell it on a higher price, right? You want to have maximum return. But if everyone, wants the best return, there should be a cost to it, right? Obviously, no one here would like to settle for a lower investment return. So what is the cost associated with high return? There's always a
Um,
trade-off in, yep,
Maybe patience.
Risk.
patience. Okay. Yeah, risk is more important. Patience is like it's talking about time, right? So time, depending on, what time horizon you are looking at, you might get a different return, but that's not the cost. The cost is the risk. So what is risk then? Someone said risk. So what is risk associated with financial economics or say in investment? How do
Like
you
having the
define the risk?
conviction to hold on to the asset.
The
So
possibility of investment losing its value. Chance of.
Okay. So the first answer was on conviction. How do you define, or how would you categorize conviction as a risk? If you can, elaborate on that. Conviction is like you think something might happen, right? And if are you trying to say that you expect something to happen, and if that doesn't happen, then that is a risk?
Yeah, you're willing to take the risk basically after all odds. So you have analyzed everything, and you're willing to pay whatever the price with the given risk.
Okay. Okay. Second answer was, the investment losing its value. So do do you mean that, the investment goes down in value and then you sell it off and you book a loss, or is there something else you want to add to it?
Actually, I limit to myself. It might, I mean, it might include the other side also. It's basically like not having a certainty. It can be on the, it can go top or go down. But as go down is a big pain for us, we will focus only on that. So it's basically the uncertainty that is tagged to the investment.
Correct. So here the risk is that it's not just about, the investment losing its value. So you invested in something and its value is going down. That is a risk. Okay. But risk here is also what you expected to happen to your investment, but it doesn't happen. So any deviation from your expectation is also a risk, right? Because see, ultimately, no one can say what could be the percentage return on any asset into future, right? Now, by looking at historical data, you can look at, Nifty data for last 20 years, and you can say that on an average, Nifty has given how much return?
12
So
15%.
15 to 20.
No, 12 to
Oh,
15%.
not 20% for sure. It's around 12%. If you look at, 20 years of Nifty data, and this includes everything, not just price, but also the dividend, the splits, bonus, everything, right, of the constituent. So if you include all the corporate action and obviously the price changes, the return would be around 12 to 14% per annum. Now, does that mean that Nifty has every year gone up by 12 to 15%?
No.
So that's an average return. So if that's not what it has grown every year, then what is the variation that has happened over this 20 years?
You mean so the deviation from the average?
Yeah.
Okay.
So we are saying that, on average it has gone up 12%, but we are also saying that it has not gone up 12% every year. So what do you think is the deviation from the average? A rough estimate.
So will it be a volatility kind of thing or standard deviation?
Yeah, correct. So yeah, that's what I was trying to get to. So volatility is the risk associated with stock here. So now how much is the volatility of Nifty over last 20 years maybe? Any guesses?
So when you say volatility, can we think of it as a drawdown also?
Um, yeah, drawdown is one of the other risk measure that is used, but volatility includes both the up and the down move.
So
So,
maybe around 20%.
okay, so on average, it has ranged, I think, around 18, 16 to 18%, the volatility. So if you look at this chart here, this clearly tells you that, on an average, the monthly returns are not same, correct? Every month you have different return. There are some high positive returns, some high negative return. During COVID in March, Nifty was down roughly 26%. I don't have 2008 data here, but I believe even that was around 25 to 30%. And then you also have a significant up month right after the COVID, but we should not kind of consider that. But say 2016, 12%, 2012 again 11, 12%. So although 12% per year is the average return over time, but obviously this is not something that will be realized every year. So coming back to risk, we know that if I invest in Nifty, sorry, my chart is not visible.
It's visible.
Okay. How do you see my screen or?
Yeah, I am on the slide. What is risk? Not the chart one. That's why.
Okay. Do you guys not see my VSC here?
Uh,
So
yes,
we
sir.
are able to see the chart.
It is visible, sir. Is it possible for you to zoom in?
Okay, maybe let me. Better now?
Yes,
Yes.
better.
Okay.
Yes.
Okay. So I guess so. I just wanted to, kind of show this return over last 15 years or so. In terms of code, we will. This is, particularly for the lecture on Monte Carlo simulation. I can anyway share the code if you guys would like to, have a look at it. But this basically downloads the data from Yahoo Finance, and this is for Nifty Bs. So Nifty Bs are basically the ETFs and not the Nifty itself. And this includes all the dividend, split, bonus, not the split, but the bonus or any corporate action which has a direct impact on the return of the asset that we are talking about. So always remember that if you are looking at index data, you should not look at the index price because that's not the return you will get. You should be looking at the ETF if you are looking at any index. In terms of risk, so my point here being that if you invest say some money today and for long term, and let's assume that whatever has happened in past will continue in future, although that's a very bold statement to make and no one kind of can guarantee that. But even if we assume that the returns will continue in future, the problem is the return are not equally distributed. Every month you might have different market movement, and at what point in time would you want to sell off your asset? And if during that month, if the market is down, then you are basically taking off your investment at a very worse worse time. So that is why the standard deviation is one of the other risk in terms of the investment. I guess everyone knows this, right? The risk and return. So if you are willing to take high risk, you might get compensated for a higher return. If you are not willing to take high risk, you will get lower return. Now, if this relation is known, have you guys seen or have observed how the mutual fund return has behaved in India? So what I have here is basically a graph of all the mutual fund categories, not all, but the major one which are offered in India. we have the risk and the return. The data is based on, I believe, 10 years of data and average of the sector. So it basically incorporates all the, the fund houses within a category, and it tells you that for each of the category, how much was the risk, which is nothing but the standard deviation per year, and how much was the return every year over last 10 years. So is there anything, you know, you can draw out of this? Any quick observations?
So for healthcare, it seems like the risk hasn't been much, although the returns have been the highest.
Yeah. So healthcare, it was 17 or 18%, standard deviation with a 21% return. Okay. That seems to be an
Also,
outlier. Yeah.
also it looked like the debt instruments are more uh, beneficial for an investor compared to the equity ones.
Okay. So why do you say that?
Since I see there is a less risk in the debt instruments like the short duration corporate bonds, government bonds, and all those instrument, and where we
Mhm.
can see the return is quite high compared to where we are seeing in the equity part, the left hand side of the chart.
No. So the black line is it.
Hello.
The black line,
Hmm.
the black line is smaller as compared to on the right side as compared to the left side. So the returns on debt in an absolute term is lower than
Maybe I have read this graph a bit differently.
maybe, yeah,
Hello.
it's
I
almost same actually.
Hello.
Yeah, sorry.
Sir, you were not quite audible. Can you explain this plot real quick?
Okay. Did I break in between or?
Yes.
Yes, sir, you
Yes,
Yes,
did.
sir.
Yeah, your voice cut out.
Oh, okay, sorry, my bad. So, okay, so this returns are as of today, as of last Friday. Uh, Sorry, this data is as of Friday for last 10 years. Okay, this includes major mutual fund categories. Okay, and the returns are based on the average of all the mutual fund within that category. So if we are talking about mid cap, this includes all the mid cap offering in India across all the fund houses, and it's an average of last 10 years. The yellow line is the risk measured as standard deviation, and the black line is the um, return. And these are in annualized term, which is nothing but your per annum. So what we see here is that if I compare, the asset classes, which is the left side you have equities, on the right side you have debt. The debt returns are more or less, constant, or not constant, but more or less in same line across all categories. So you will see the most of the debt fund has returned from 4% to maybe 8 or 9%. However, on the equity side, the returns are quite diverse. So we have as low as 7% to as high as 21%. But in terms of risk, the equity is almost in range of 16 to 20, 22%, correct? And that is what we saw for Nifty as well. For debt, there is no risk. I mean, sorry, that's not a technically correct statement, but the risk is very small in debt instrument. The variability in the NAV or the daily standard deviation in the NAV is very small as compared to equity. So the point here is that if you take low risk, you get lower return. For high risk, you get higher return. But here we also see that for some of the mutual fund um, categories, even if there is a high risk, like say small cap, the return has been only 10%. And this includes the drawdown that we are currently seeing in the market, right? So even if the risk is high, the return is small. So this relation holds true, but it doesn't mean that high risk will always mean high return. That statement is not always true. Low risk, low return will mostly be true for the debt instrument, because in debt instrument, and for bond, we know the value of the bond will get pulled towards par, and it will expire at par value, and you keep getting the coupon every month or every quarter or every year. So the return can be easily computed or easily estimated in debt as compared to equities.
So just a doubt, like
Mhm.
when we are talking about risk, high risk or high return, we are trying to compare it with someone. So over here, like if that statement doesn't hold true, like even the risk is high when we compare it to the debt instruments, or return when we compare again it to the same debt instruments, they are both usually high on an average. So that statement may hold true, right? That the higher risk may give you higher returns when we are
Yeah,
comparing it to.
correct. So relatively, if you are saying if I compare debt and equity, I know that in equity there is a high risk, but there is a potential for high return. Correct. In debt, I know that the risk is small, and I know there is a certain limit at which I can get a return. Beyond which, do you think getting 14 or 15% return on debt instrument is possible? At least for say Indian market, because in India, if you look at government securities, they are issued at 6% or 7%, right? Or this is because because of the recent rate hike. But if you look at the long term average, it would be around 6%. 5 to 6% is the rate at which government issues the government securities, which are considered risk free. If you invest in corporate bond, you might get better return as compared to government bond, say a 2% better, maybe you might get 8%. If you invest in a very risky junk bond, say some of the startups of fintech startup, like say early salary. I hope you guys know about early salary. They are basically P2P lending, I believe. They have their bond, right? The return, if I invest in that bond, I think the return would be roughly 12 to 13% if I hold the bond till maturity. But what is the risk there as compared to say the government bond, or say any large scale corporate? What is the risk in investing in early bond as compared to say government bond?
I think the company might not establish and may file for bankruptcy, or bond might not hold till maturity as well.
Yeah, correct. So there is obviously the risk of default. So if you, I mean, if you guys are interested in investing in bonds, right? I guess this is one of the site where you can actually buy bonds. And obviously, I'm not kind of, marketing this site, but I have personally invested through them, and that is why I'm showing this. But basically, here you can see multiple products within bonds. So you have government securities, sovereign gold bond, you have state bond as well, you have corporate bond. So this is the Adani, Hinduja. And then if you look at some risky one, let me filter high yield. So you have Satya, early salary. And if you look at yield, it's roughly 12%. This one has like 15% yield. Okay. And some of you might not know what yield is, but basically if I invest in this bond, I hold it till maturity. Sorry, let me just go back there. So if I invest in this bond, which is maturing in 2029, right? The investment price is roughly 1 lakh. So one bond is 1 lakh rupee. It will give me 14% coupon every year, right? And if I hold this bond up to maturity, that is 5 years from now, my return on this investment would be roughly 15% per annum. This is, as high as what we get on Nifty on a very long term. So if I know I am getting 15% for sure on this investment, if I hold for 5 years, why would I not invest in this one?
Maybe here the yield is fixed. There is some possibility that in particular year it might go up. Actually, maybe that's the average value, right? Therefore, we have that little greed, or maybe from the consumer side, as an investor, that it might go up more than 20% or something in 1 year. I can sell it off.
Okay. Yeah, that so basically what you are saying is the potential return on Nifty or any equity is higher as compared to bond, because in bond I know this would be the max return I will get, right? Yeah, that
Yes.
is one way of looking at it. The other way of looking at this in relation to other bond is that this bond is actually risky, because some of the characteristics of this bond. So this is subordinated debt. So if this bank, or sorry, if this corporate goes bankrupt, you are not first in the queue to get their asset, right? You are not first in the queue to get compensated, or whatever recovery they are able to do by selling the asset of the corporate. You are not the first one to get the share of that. You might be further down in the queue. That is one reason. The other reason is the company might not be good. The rating of the company is not good, and for that the investor are demanding a higher yield on this. So there could be multiple reasons for that, but relative to other bond, this, if something is giving you higher yield, that means there is a high chance of default as well. And here the default can be in terms of they not making the interest payment, or they defaulting on the principal itself.
Milan, if I may request, what's coupon percentage and difference between coupon percentage and the yield percentage?
Okay, so coupon is basically if the face value of this, I'm not able to open it. Let me see. Sorry, we are a bit deviating from the topic, but I think it's worth understanding this part. So while I do this, basically coupon is if the face value of the bond is 100 and the company. So how does bond work is that, say a company ABC, they want to raise fund, right? So what they do is they come to investor like us. They tell us that you give me 1 lakh rupee. Every year I will pay you 10%, and on every end of year I will give you the coupon which is 10% to in your account, right? So if say it is 1 lakh investment and the coupon is 10%, so 10% of 1 lakh is 10,000. So every year you will get 10,000 in your account, which is the interest. Basically, that's the coupon. That's the fixed amount you will get until the maturity of the bond. The yield is nothing but how much is the return if you invest in that bond today and at a price which is not 100, because bond would also have its price. So when the bond is issued by the company at the start of the investment, the price would be 100, but then that will keep on changing as as the interest rate in the market changes. So if you look at this bond here, the price is roughly 1,962. So price is higher than the face value of 1 lakh. The coupon 14.2% will be paid on this. What this 14.8 says is that if I invest in this bond today by paying this amount, and whatever interest I get every year, which is roughly 14,000 every year, and if I reinvest that interest at some rate, then my overall return on this entire investment is roughly 14.8. So basically this yield captures the price that you paid plus the interest that you will get, and assuming that the interest that you get every year in your account is also reinvested. If you incorporate all of this aspect, then what you get is a percentage return that you are expected to earn on this if you hold this till maturity.
So, sir, the yield percentage is assured every year?
No, no, no. So tomorrow the price might change, right? So if tomorrow this price changes, and if you invest tomorrow, the yield might be different. What is assured is
So
this, and
14% but on the same price. If the price is changed, then 14% on that price.
no, if the price, so this amount is computed, or sorry, this percentage is computed by a formula. The input is the price that you pay today and the future interest. So if the price changes tomorrow, then this will change, right? The fixed part is this, the coupon on a bond. So if you do FD, right? If you do FD in bank, they say that we'll give you 6%. So you know that every month, if you take a payout every month, every month 6 divided by 12%, 6% divided by 12 is what you will get in your account every month. That is what this is, coupon. This is incorporating the price that you are paying today and assuming that you hold this bond till maturity. Uh, does that answer your question?
Yes, sir.
Okay. Yeah. So basically, risk and return, like I said, there could be a direct relation, but it doesn't necessarily mean that high risk will always give you high return. Actually, the risk is here that it's the variation in the price of the underlying. So now, since we are talking about risk, right? There are two main types of risk. One is the market risk. The other one is unsystematic or specific risk, or we also call it as an idiosyncratic risk. So market risk is, you know, if Nifty is moving, right? Say if, over, not just Nifty, sorry. Say if the global market is going down, the overall market moving is basically the market risk, which is not controlled by you, or which is not something you can deal with, right? Say if the market is going down, is there something you can do to prevent it to happen? is there something you can do so that you are not, you know, impacted by the overall market going down?
No, we cannot eliminate systematic risk.
Correct. And that is why it's called systematic risk. And this risk comes out of macro factors. So macro factors are what? Interest rate. Say the central bank coming and hiking the rate, or there is a sudden, spike in inflation, or there is a, geopolitical issue where, Russia starts another war with another country, right? There is a crisis in, say, Middle East, or there is a escalation in China and US tension. There is a trade war. All these macro factors has a direct impact on the market. Those are basically market risk and which cannot be diversified away. You can't do anything about it. And those are basically systematic risk. So most of the risk that we'll learn, and also as a part of, market risk module, will be focused on this area, how to manage those and not how to mitigate those. Managing is what is required in market risk. The other risk is basically unsystematic risk or specific risk, idiosyncratic risk. So these are very specific to a thing. So say if you have invested in a stock of, say, a company, and suddenly, I guess maybe let's take an example of a recent news that's happening, or that, that is kind of dominating the market, at least in the banking space. So we know that, the in terms of the FX booking that they have done, it was not mark to market, and because of that they are doing a one time drawdown which is impacting roughly 12% of their NAV. Now this is very idiosyncratic to the bank. Why? Because this is something which has happened within the bank, and it's not a market event which is impacting all the bank. Correct? If you want to diversify away that risk, say if you had invested in the bank, and if you want to diversify away that risk, how would you do that?
Diversifying our investments.
Correct. So instead of, uh, you only investing in the IndusInd Bank, you had diversified across multiple banks. So say instead of putting 100% of your money in IndusInd Bank, and now that the stock has gone down 30-35%, your investment value would have gone, it would have gone down by 30%. But instead of putting your 100% entirely in one bank, say if you wanted exposure to banks and you had diversified across multiple private, public, private bank in India, then the diversification basically reduces the idiosyncratic risk, because the correlation between two banks is not perfectly one. It is less than one, or it can be negative in some cases as well. So that kind of helps you diversify away some of the unsystematic risk. So diversification is one way to, kind of mitigate some of the unsystematic risk, but systematic risk cannot be diversified away. And since I talked about correlation, I assume everyone knows what correlation is, right? Correlation, positive correlation is basically if something is going up, the other one is also going up. It's a positive correlation. Negative is the opposite, one going up, the other going down. Uncorrelated is there is no relation between both the asset. Okay, so this is just, all these concepts that we are discussing right now are just a backdrop to, what we are going to do in future, or going ahead. But is there any questions so far? Okay. The next one is beta. Anyone knows what beta is or heard of beta?
It's like how sensitive the particular stock is in relation to the market.
Correct. So beta tells you that what is the relation of the stock with respect to market. And here the market, and whenever we use the term market, we mean a diversified broad based index. So for Indian market, it is Nifty. Bank Nifty is not a broad, diversified index because it is very specific to banks. So it is a sectorial index. So Nifty is a market, S&P 500 is a market, FTSE is a market, Nikkei is a market, ASX, the Australian index is a market. So any broad index which has its constituent spread across sectors, across companies is an market. So what beta does is that it basically captures the relation of how the stock moves in relation to market. So say if the Nifty is going up 1% and the underlying stock that we are looking at goes up by 1.25%, it means that the beta of that stock is 1.25. 1.25. Basically, it's the whatever market moves, the underlying will move that into 1.25. That is what beta is in relation to equity. Now, beta can also be thought of, the sensitivity to other risk factors. So what could be the other risk factor which has an impact on, say, equity? So there are some ways through which you can model the market return to a risk factor. So what is a risk factor? Before we go there, what is a risk factor? Risk factor, think of risk factor as an independent variable which moves on its own, okay? And it has a direct impact on the dependent variable. So here, if we are talking about, say, equity market, the equity market returns are dependent on risk factors, and those risk factors are basically interest rate, inflation, GDP, currency, various factors, right? If interest rate changes, we know that it will have an impact on equity market. So what if you want to quantify that, you try to derive the sensitivity of that, and that sensitivity is nothing but the beta. So beta in a broader term is basically a sensitivity of a dependent variable on an independent variable, and it kind of captures the or quantifies the magnitude by which it is sensitive to the independent risk factor. So beta is just not about equities. It can be, broadly applied for sensitivity analysis as well. And beta is the way through which you quantify the systematic risk.
Excuse me. Hello.
Yep.
Yeah. So I just have a doubt that when we say beta, so in that the dependent variable is the return and independent is the index, is it? Or
So for equity, if you are talking about equity,
yes,
say if you
yes.
are trying to, you know, get the beta of HDFC Bank, what you look at is how the returns of HDFC Bank has behaved in comparison to Nifty.
Yes, so dependent is the return, right?
Yeah, return of HDFC Bank. So HDFC Bank returns are dependent on
The
the
index.
independent factor, which is, yeah, Nifty.
Okay, thank you.
So how do you compute beta then?
I think it's a regression process.
Yep. So the stock beta is nothing but covariance upon variance of the market, right? Let me see if okay, so I have some historical data here. We'll be looking at this maybe tomorrow if time permits, and today, otherwise tomorrow. But basically, I have few data of few of the companies across sectors: so L&T, Bajaj, Asian Paint, ONGC, Power Grid, right? And these are their historical prices up until October 23. And I also have Nifty data as well. And I have computed basically the beta of each of the stock. So L&T, the beta is roughly 1.1 based on this 10 years of data. If you compare this with ITC, so ITC we know has a very low beta, right? If you compare this with any of the banks, I don't know if you have bank, yeah, SBI is 0.6. So some of these oil and gas almost 1, Adani Ports 1.2. So you have various betas depending on what stock we are talking about or what industry that stock is. How you compute this is nothing but the covariance by variance. This can be, computed using various time period. You can use 10 years of data, 15 years of data. So that is more of an art than a science, to be honest, what time period to look at, because you want, if you are looking for a very long horizon period, then maybe you take the full period. If you are looking for a specific period, or if you are thinking from a risk management point of view, then you might want to take betas during the stress environment. So you want to see the beta, how the beta has behaved, say during the COVID as compared to during 2018 period when it was low volatility environment. 2020 was high volatility. So the betas, if you look at only that 1 year period, the betas might be different altogether. So it has a regime depending on what market environment we are in. The betas can vary significantly. Beta can go above 1 during stress environment, and beta can be low during calm period or when the market is going up in general. There is also this common phenomena of the correlation across equities go towards 1 during stress environment, and it goes towards 0 when we are in calm period or in general the market is going up. Why do you think that's the case? Or have you guys heard or read about this, that the correlation between the stocks and also asset class actually goes up during this stress environment?
maybe has something to do with like just the general emotions of the market and like everyone is fear selling.
Okay. Okay. Yeah. Any other answers?
During stress environments, I think all asset classes across the board are usually correlated, and maybe that could be one of the reasons.
Yeah, but why are they correlated? Why? Okay. Why do you think? So typically you will see.
Systematic risk affects everyone,
Yeah.
like
Correct.
all the
Correct.
entities. So
Yeah. So normally we know that gold and equity has a inverse relation where gold is basically a hedge to equity. But if you look at gold price during 2008, I think it corrected roughly 20% when the market was down 30-40% during the Lehman crisis. So I mean, you might have invested in gold thinking that to be a hedge to equity, but you could see in your portfolio that the equity has gone down 40% and even the gold has gone down, roughly 20%. So typically during a very severe event or severe stress event, you will see the correlation between asset class actually go towards one. They become highly correlated, and gold in particularly actually gives you negative return during a very stress environment because people are basically selling off their asset to go and hold a cash, because during stress environment typically the risk aversion of an investor is very high. They don't want, they might let go some return, but they would like to have a peace of mind. And that is why you will see a fire sale happening across asset class, including gold, during a very, very severe stress environment. Otherwise, you might see, gold kind of retaining its value during such environment. So gold is normally considered to be a good hedge. Is there any other asset do you know of which are, safe haven during a stress environment?
The US dollar and Japanese yen.
Are not US dollar. US dollar is actually not a safe haven. It's actually Japanese yen and Swiss franc. I think more than yen because uh, over last 2 years, with what has happened to Jap- Japanese economy and yen in particularly, after they have hiked the rate, you can see that the carry trade getting unwind and so on. The volatility in USD yen has gone through the roof, and I don't consider that to be a safe haven anymore. The only safe haven in terms of currency, I think, is Swiss franc. If you look at
Right.
Swiss franc uh, price,
But sir, I would like to understand like US dollar and Japanese yen used to be the safe haven, right? And
uh, the
how
problem.
did how did this US yen, I mean Japanese yen became a safe haven in the first place?
Okay, so first of all, Swiss franc was before this, right? When this happened. Sorry, not this. Uh, yeah, I think, sorry, this one. In 2011, the peg was broken. So Swiss franc was pegged to dollar up until here, and then post this, I think in 2011, yeah. Let me double check. Oh, it was 2015. Yeah, it was 2015. So here, yeah, this spike. So what happened here is basically up until here, I think it was pegged, and then post this, I guess the economy was not doing great, and they came and said that we'll break the peg. But even after breaking the peg, you can see that it has kind of retained the same value across multiple years. In last 10 years, the variability has been very small. It's only when during this period there has been some, event in Europe that is kind of driving this price change. But if you compare this with, say, yen, the USD yen had been kind of, stable up until here. But from here, what has happened is there's this the yen carry trade. Yen interest rate has been close to zero or, negative for several years. So globally, what happens is that most of the financial institution, they borrow yen from Japan at, close to zero rate, take that money, convert that into either dollar, euro, or any emerging market currency, and invest in risky asset. Okay, and they kept on doing this year after year. Now, what happened last year was the the interest rate in Japan started going up. The central bank started increasing the interest rate, and because of that, the global investor who had borrowed in yen, they have to unwind the position now. They can't afford to pay a higher interest rate. Sorry, if you can go on mute, uh, Vinith. I guess there's a lot of background noise. Yeah. So what happened is because of that, there has been a lot of uh, unwind happening in the market. So whatever investment which was done in the risky asset, say emerging market like India, Mexico, China, or even in, say, US treasuries, right? Because US treasury would give you 4-5% as compared to yen, which was close to zero. So all those trade are now getting unwind, and because of that, the money is flowing out of those risky asset again back to repaying the loan that was taken from yen. And because of that, the yen volatility has gone up significantly. That is the major issue. It has been stable over years because of the low environment and a very stable environment. I guess it has been close to zero for roughly 20 years, if I'm not wrong. I guess starting 2004-5, the rate has been constant, close to zero for Japan. Swiss franc is still stable as compared to yen, I think.
No, but why not US dollar? Why don't you? Why
Okay,
can't you
US,
consider?
yeah, US dollar. Actually, the thing is, most of the, the investment into risky currencies like emerging currencies, India or China, Mexico, Brazil, those actually come from US. So what happens is that when there is a risk on scenario, risk on meaning, everything is rosy across the world, everyone wants to take on risk, the money flows out of US. Because in US, if you invest in US treasuries, you might get 4-5% during, say, a normal interest rate environment. In a market like India, you might expect 10-12% from equities, right? Say other currencies, similar return. So what happens is most of the currency then start flowing out of US. That creates a volatility in dollar. If you look at, dollar against major currencies, the G10 currencies, the volatility would be higher as compared to, say, USD yen.
So only Swiss franc, you'd say.
Yeah. Swiss franc is, I think, the only safe haven if you consider from a riskiness. Yeah.
So when you said the Swiss franc was pegged previously, right? It was pegged to the dollar or it was pegged to the gold.
No, it was never pegged to gold. I don't think any currencies are pegged to gold. It was a dollar. Let's double check that. So in 15, right? Yeah, this one. Okay, so SNB set a minimum exchange rate of 1.2 CHF to euro. So it was capped to euro. Sorry, yep, it was capped to euro.
Okay. And also, in 2014, Swiss central bank introduced negative interest rates, right? That means
Yeah,
depositors have to pay money to store money in the bank. So, does it mean that even the loans were um, given it to people at probably close to zero interest rates?
yeah. So I guess Switzerland in general has a very close to zero interest rate environment. So it would be not obviously not negative, but very close to zero. You might at a individual level you might get a loan at a very low interest rate as compared to say dollar. If you have to kind of borrow in dollar as compared to Swiss franc, the Swiss franc would be way cheaper, similar to what we see in Japan as well.
Sir, I have a question. Sorry to interrupt.
Yeah, yeah.
Yeah. So the question, so to give a bird's eye, I mean, to zoom out, the thing why they become very correlated asset classes, that their association between them among them increases is maybe the system. I mean, there will be more dominance of systematic risk, right, during financial stress, which is like COVID or something like 2008. So
Yep.
the systematic risk will have more dominance, that people are not ready to focus on company specific things, but are in a panic mode to get out of these things. Can this be somewhere related to a behavioral aspect, or that's it?
Yeah. So what you will see is immediately after a bad news, right, which could have a systematic impact, say a bad news in terms of a missile getting fired, say out of North Korea or Russia, that would have immediate knee-jerk reaction to market. That is happening because see, if as soon as the news come out in market that there is a geopolitical tension, you don't know the full story yet, right? But what market participants typically do is that they try to get out of some of the positions which are beyond their risk appetite and try to contain their risk. So that creates a immediate sell off across the market. Now as that development happens and you see there could be a wider issue and things might get worse, people start deleveraging because most of the market are based out of leverage. There is a lot of leverage in the market, and if there is a and leverage could have a very severe impact on your return during a down move. So first thing that happens is deleveraging. People start selling off at whatever price they can and try to get out of that leverage position. That creates a sell off which might actually not be fairly valued. So one example is say in 2020 during March, as the news started, if you try to recollect COVID, the first news started coming out of China, right? I guess that was in December or Jan, if I'm not wrong. Sorry, before that. And then during
November
December,
2019.
yeah, yeah. And then December, Jan, I think slowly other countries started reporting some cases. And it was during March when, all the lockdown and everything started, and we saw market going down roughly 20-30%. Now, if you look at returns or the price chart, say of Nifty, you will see a V-shaped recovery. Why do you think if market going down 20-30% and then it again coming back to its original level in few months, what does that imply?
It's like when as the external condition, the factors that affect at the market level, like systematic factors. So people just stepped out. Then once those factors are coming to normalcy, maybe they again re-entered.
uh yeah, so maybe the other way of looking that is that when this crash happened, so say by the March 27 was the lowest, I think, and then by, I guess, August or September, it again came back to its original level or wherever it was before the crash. What happened is that, and this, it's not that it came up in few days. It started climbing up, I guess, immediately after crash. You had volatile days, but it was actually going up. The direction was up. What was happening is basically the initial reaction might be way too severe as compared to what would have actually happened. Meaning that, see, people started thinking lockdown means, the business are stopping, there is no sales, everything is, GDP will go down tremendously and so on. But actually, as few months pass by, we again open up everything. The lockdown is kind of, not very restrictive. People started spending again, and that created again a V-shaped kind of recovery. So this reaction that you typically see, and this would be the case in 2008 as well. But here the problem was whatever happened in the market had a very wider impact across globe in terms of financial market, because those were leverage position. All the CDOs and the double derivatives were all leverage position. It had a very correlated impact across all the asset class. The recovery here you can see is not as fast as COVID, because in COVID, I think what happened is the amount of the negative impact of lockdown and the COVID in general was overestimated, and that created this severe sell-off, and then market started actually going back as lockdown opened. Here it was more systematic in nature, spreading across asset class. And if you look at the gold, here it was this period when gold had actually gone down 20% when the market had gone roughly 30-40%.
So, sir, in continuation to that short question, so when you pointed out at the events around 2008, where the effect was more systematic, so at that particular point, there is no possibility for any diversification, right? Because everything
And right.
becomes,
Yeah, yeah.
yeah.
So, and typically gold, right? Because see, the gold, you might think that gold is a safe haven, but actually during stress environment we can see that even gold will start losing its value, because people want to stay in cash, because the cash is something that will be accepted and its value will not change, right? Because if you hold a you know 500 rupee note, that government of India will give you 500 rupee or give you the goods equivalent to 500 rupee. The value of that will not change, but the gold value will change. It might have severe impact depending on what development is happening in the market during that stress environment. So the tendency of the investor is to go towards cash, and to go towards cash, they start selling off significantly. That creates this correlation which goes towards one across all asset class.
Understood, sir. Thank you.
Okay, so yeah, I guess this we covered. These two terms we'll be using more often. So I believe everyone knows what covariance is and what correlation is, how you compute that. We'll be looking at some examples on this today. Thinking, should we take a break here and let me just quickly check. Yeah, maybe let's cover this 3 slide and we take a break and then start the next topic. So the other term we'll be using is risk-free rate. Okay, so what is risk-free rate?
Return with no risk.
Return with no risk. Okay, do you think there is anything which has no risk?
Not really.
Right. So actually risk-free rate is not completely risk-free. There is a very small risk involved there as well. But typically what we in in our area of finance, what we consider risk-free rate is basically the interest rate that government is giving you as a part of their sovereign debt program. So if you invest in Indian government issued bond, and this bond can range from say 90 days to as long as 30 years, right? So depending on what tenor you choose, you will get different interest rate. This different interest rate are basically risk-free interest rate. So if you invest in those bonds, you know that the government will pay you the interest rate, the government will pay you the principal, and basically your investment is risk-free as compared to any corporate bond that we saw earlier. There are chances that the corporate might default and they might not pay you the interest rate or the principal back. So there is a credit risk involved there. But in terms of sovereign bond or the government bond, there is no risk, and that is why we typically consider those to be a risk-free interest rate, risk-free bond, and the yield on those are considered to be the risk-free rate that we will be using going forward. Now, if I say the risk-free, the government issued bond is basically 6% YTM, it doesn't mean that the value of that will not change. So if you hold that till maturity, yeah, you will earn 6%, but the value will change during the life of the option, during the life of the bond. And that changes is nothing but the standard deviation of the, not the standard deviation, but the fluctuation that is happening in the interest rate, the underlying interest rate. So there could be variation in the investment value, but if you hold till maturity, then basically that is the yield that you are going to earn on that investment, and that yield we consider to be risk-free rate. We will cover this slide later. Now, in terms of total return, okay, now if you think of any investment, we always think of, return as the first thing that comes to our mind. Returns can be broken down into 3 parts. One is the risk-free return, the second is the beta, the third one is the alpha. Now, if you are given a choice, right, to invest in something which is risky, and now remember that when I say risky, that means it has uncertainty involved in this, and it's not guaranteed that you will receive certain amount at the end of the investment. That is risky. So if I give you a choice between investing in a risky asset and a risk-free asset, would you settle for the risky asset if the return on the expected return on that is same as risk-free rate? So if Indian government bond is paying you 6%, would you invest in a risky asset which has an expected return of 6%?
No.
No.
Right. So you will ask for a premium on that, and that is basically risk premium. So any risky asset would demand a higher return, right? And that again depends on how risky the position is. And those risk premiums can be broken down into beta and alpha return. So beta is like what I said is basically the variability of the underlying with respect to the market. Alpha is basically how superior your investment skills are in selecting a right kind of stock. This two combined will give you the total return of the investment. So if you are say doing a investment in a mutual fund, how would you go about evaluating your investment or your mutual fund return and breaking it down into component so that you understand from where the return is coming? Is that because of luck? Is that because of the ability of the fund manager to do a right kind of selection, or the return on your mutual fund has been directly because of the market move? Breaking this down is important, and that is why understanding this concept is important, that total return are basically risk-free rate plus beta plus alpha. We'll be looking at few examples of this, I guess tomorrow, if not today. Yeah, definitely not today. Tomorrow we'll be looking at how to evaluate the portfolio, or basically do a portfolio performance evaluation in comparison to benchmark. This would be an interesting one, because I guess not everyone think of returns from or as a comparison to a benchmark. They always people typically think of return in isolation or in absolute term as compared to in relative to a benchmark or the index. Okay, I think maybe let's take a break here, and then we'll start the next topic. It's 4:50. Before we go on break, any questions so far on what we covered?
So just wanted to confirm a statement. Hello.
Yeah, go on. Yep.
Yes, sir. So, risky, so the if we invest in a more riskier manner, it should have a higher return than the risk-free return.
Uh, yes. Okay. Let's say that the expectation is higher. Now, will that expectation realize or not? That's a separate story, right? The
Okay, sir.
expected return, there is a difference here. The expected return is basically the return that you expect that you will have in future. When we say historical return, we look at historical data and see that this has been the historical return. So when we talk about risky asset as compared to less risky or risk-free asset, the expected return on risky asset is higher as compared to the risk-free asset.
Yes.
Okay. Uh, it's 4:52. Should we take 20 minutes? Is that good enough?
Yeah.
Yes, yes,
Okay.
yep.
Okay. So let's come back at maybe 5:15.
To
This
record this.
conference will
Yeah.
now be recorded.
Sure, that is
Right.
it. Thank you.
Yeah. So the weak form is basically saying that all the historical price and returns are already captured, in the price that we see today. Now, if that's the case, what it means is that I'm not sure if everyone kind of knows about technical analysis. Anyone knows or uses technical analysis?
Yeah,
Technical
man.
analysis,
Yep.
yeah. So technical analysis is, looking at historical price, correct? And then, kind of deriving an expected move in the stock by looking at the historical price. And that is basically plotting the prices historically on a graph and drawing or doing some analysis on those and trying to predict the next expected move on the underlying. That is what the technical analysis is all about. So a very
Is
good,
it correlated to backtesting, sir?
no. Back testing is different. Back testing is basically you are checking how it would have happened. I mean, say if you have a, let's say if you have something, if you have a model which kind of tells you that there is a 99% chance that the loss will not be say 10 million. Say you design a model and you say that with a 99% confidence that the loss will not exceed 10 million. That means there is 1% chance that it will exceed 10 million, right? Now, if you are looking at, daily PNL of last 1 year, 1 year has how many days? 252 days. So what it means that there is 1% chance, which is out of 250 days, say 1% is 2 or 3 days. So what it says is that there are 2 or 3 days in a year where the loss is more than 10 million. So checking that on a historical data is a backtesting. Technical analysis is basically using the price information of an underlying to predict what will happen in future. Maybe let me show that on. So everyone might have heard about moving average, right? I guess that's the most basic one. Everyone knows about moving average concept,
Yes, sir.
right? So what does moving average do?
Uh, it depends on number of past data points that can be included, so as to observe how the trend is changing. So we have 200, and the famous are actually 250 and 100, these three.
Yeah, correct. So basically, and how do you interpret those data? Say if the current price is about 200-day moving average.
Use them as support and resistance.
Support and resistance, okay. That is one way, that is, the other way of looking at technical
There may be
analysis.
some indicators like
Yeah,
MACD.
correct. Correct. So, right. Now, so basically what technical analysis is all about is, basically I have Nifty chart here and I have the historical data, and there are some, predefined indicators you can plot. So all these indicators are basically what we call as technical analysis. So say if we look at the simple one, which is a moving average. Okay, so I click moving average and let's say we take 9 day. So this is using a 9 period average. So what happens is that, let's do a line chart. So say the value here is 23,352. So the 9 closing price from today, the 9 previous closing price, the average of that is the value which is plotted on this blue line. So this blue line is basically the moving average, and it keeps on rolling as you go ahead in time, or as you record a new observation. So for every new observation, this will move ahead also, and the old 1 day or whatever the time period here is, right? So 1 day will go away, and the new recorded value will be added into this moving average. So you see now here two lines. One is the actual price path, right? And this dark blue line is the moving average line. And a very basic form of technical analysis is that when the price is below the moving average, you expect the, I mean, if you are looking from a mean reversion or from trend point of view, it could have different interpretation. But basically, if you are looking at crossover, right? So if the price was above the moving average, above this line, it has crossed and went below the moving average. Here it crossed and went below, right? So the expectation is the price will fall further. That is what we see here, right? And then beyond one point, it bounced back. Here it went again above the moving average. Then the expectation is price will go up. This is like the very basic definition of technical analysis. There are various indicators. Moving average is one of the basic ones. There are many indicators that are designed to kind of analyze the price movement historically, and based on that analysis you try to predict what will happen in future. That is what technical analysis is all about. Now I hope that is clear. Okay, if coming back to this, what it says is that the price today incorporates all the historical data, right? If that is true, then whatever this technical analysis is predicting is actually not efficient, because the price movement are random right now. Even if you do a technical analysis on it, the assumption here says that all the historical data has already been captured in the price that you see today, which kind of hints that the technical analysis is not something which will give you superior return or which will beat the market. This is the weak form of market. Anything not clear on this? I guess when
Is
we
the perspective to look at the market or that will weak and semi-strong and strong? And is the perspective by which you are seeing the market or not?
sorry, your voice was very feeble. Can you maybe repeat that again?
So I was saying that are these the perspective by which we are seeing the market?
No. So what we are saying, so efficient market hypothesis says that it tries to classify, the markets are either weak, semi-strong or strong. Maybe if you, as we complete this three forms, you will understand what we are trying to say. Right now, understand that if we are saying a market is of weak form, what we are saying is that all the historical data is already captured in the price that you see in the market today. That is what the weak form is. The conclusion, or what we derive out of that is that if you perform any technical analysis, it might not give you return exceeding the market. You will not be able to beat the market. The semis, yeah,
So
go on.
small doubt here. So basically, we are saying that these all moving averages or whatever we calculate, which are based on past 9, 10, or whatever may be the days, can't give us an edge over remaining people to have a better prediction over the price
Yeah,
because it's
correct,
already there in that.
correct. Yes. Yeah,
So they can only so according to that they can only make profit based on the new information, but old information is, I mean, useless.
yeah,
Past information.
correct, correct. Yes,
Fine.
precisely that point. Yep. So that is weak form of market. Semi-strong market is, so whatever we said in weak form, that applies. Over and above that, all publicly available information is already factored in the market, and any new information which comes, right? So say if today there is a bank earning, so any new information which comes into market gets immediately captured. So say if there is some earnings coming out of market today, right? Say if one of the bank has a earnings today and they come out with a bumper, net profit during the year. What will happen is the price of the stock will immediately move, and that new information which became public now, because it was not public, only the insider of the bank would know what was the net profit, and not everyone, right? I mean, all of us kind of work in a corporate, so we know that not all information is available to you. There are few sensitive information, and more particularly if your company is a listed company, you know that you don't have access to all the information. There are sensitive information which you might not get access. So even within a corporate, you know that only the top management or only a particular team would know that, what is the full year profit and, the balance sheet. That information, as soon as there is a news press and company releases that information, it becomes public. As soon as it becomes public, the price will adjust such that whatever is kind of getting released on that day is getting incorporated in the price post the reaction of the news. That is semi-strong. So basically, semi-strong says that any new information coming is getting captured immediately. And what it implies is that fundamental analysis, right? Now, you might have heard of fundamental analysis. Fundamental analysis is technical analysis is looking at the price, historical price, and trying to draw a conclusion on what is the expected move in the stock price. Fundamental analysis is basically looking at the company itself, looking at the industry in which the company is operating, doing an analysis on that, forecasting into future of what the company will be able to do over next 5 year, 10 year. There are various concepts that are used within fundamental analysis. So say discounted cash flow is one way to kind of arrive at the fair value of a stock. So how you do that is basically you look at the future balance sheet, profit and loss of a company. You forecast into future. How do you forecast? You have a call with the senior management of the company, say the CEO, CFO, where you ask them questions, or there are analysts who are tracking the market. They ask just questions during earning calls to the senior management, that what are your expected sales, what are your expected growth over next 5 years, what are you planning to do as an investment, what are your expected returns, what are your costs associated to it, are you able to reduce your cost. All those questions are asked to senior management. They give guidance. In no one can tell you that this will be my sales in next 5 years. So they give guidance in terms of what they expect to happen or what they are planning to do so that they achieve something. Based on this conversation which is happening during earnings call, or this kind of setup, the analyst will focus into future, the expected profit and loss and balance sheet of the state of the company, do the free cash flow, arrive at the free cash flow, discount that free cash flow, and find the value of the company. That is what the fundamental analysis is. Now, if we are saying that the market is semi-strong and any new flow, information flow or news is getting captured immediately, then fundamental analysis is useless, because or it can't give you edge over others in terms of predicting the future, because any information which is public, right, not private side, any information which is public is already captured in the price that you see today. So any kind of fundamental analysis you do will not actually help you in predicting what will happen in future. Clear? Any question on this?
Yes.
Okay. So now if you do more restrictive assumptions, so earlier we said historical data, then we said all public information. Now we are saying both public and private information are already captured in the price of the security. Then in that case, no one can actually beat the market, right? I mean, if the market is of strong form, no matter what kind of analysis you do, because even the private information which is not available to everyone, even if that is captured in the price that you see today, then there is no predictive power or there is no tool or analysis available that can have an edge in terms of predicting what the future return of a investment will be. That's the strong form of market.
Sir, one naive question here.
Hmm.
So, if suppose in a hypothetical situation when all people are very literate financially, that they can
Okay.
read all the public information, they have all the access. So basically, we are saying that there is no way that people can outsmart the Nifty if Nifty is taken as a market index.
Hmm.
So Nifty's return is the max that you can get in such sort of environment, right? And if it is a strong,
Yeah, correct. Yeah.
uh,
So basically what it means is that you actually you can underperform as compared to market, say Nifty here, but you won't be able to outperform the market.
yes, sir, that's what I meant. Yeah, yeah.
Yeah, correct. Yep. So if this is clear, what do you guys think are the markets currently? What form of market do you think we currently see? Is it weak? Is it semi-strong or strong?
I think it's in the
Semi
range
strong.
of semi-strong to weak, that part.
Semi strong.
Max it is semi-strong, sir.
Yeah, I think so. I don't think anyone can kind of answer that or you can quantify this. But what I think is also the same, that it is at least semi-strong, if not strong. So it is somewhere between semi-strong and strong. It is definitely not strong, and it is definitely not lower than semi-strong. So it is somewhere here in between. And as we leverage a lot of technology, I think we might go towards strong, or as the compliances increases and all the insider trading that happens, that kind of goes away. I think we might go towards strong, but somewhere here is what I feel it is. Maybe few years back, or not few, but many years back, I think we might be at semi-strong. But as the technology help us to cascade the information at a very faster rate, I think we are at least semi-strong right now, because everyone has the same information at same point in time, right? If there is a sudden news happening in the market, everyone has that information. Earlier, that was not the case before the internet, or say before the mobile technology. So we are, I think, somewhere here in between. But now, okay, so this is like kind of theory, right? How do we
So here
actually?
the base is always considered to be Nifty.
So market, let's say market. So for Indian market, for equities, you might consider that to be a Nifty or any broad index, but Nifty could be a good
So
proxy.
you said initially in the session that either it's like Nifty or S&P 500.
Yeah. So for US market, it would be S&P 500. So any broad index. So for Indian
Okay.
market, it's Nifty. For US, it is S&P 500, or it could be FTSE, Nikkei, depending on which country we are looking at. So you won't be, comparing HDFC return with a benchmark which is, say, S&P 500, right? I mean, that doesn't make sense. So you will obviously compare Indian companies with Nifty, the US companies with the US index. Depends on what portfolio you are looking at. If your portfolio is global, then you might have to look at global index. So MSCI has a global index available. So if your portfolio is only Indian, then maybe Indian equity index is a more relevant benchmark.
Okay, sir.
So let's look at, some arguments for and against of efficient market hypothesis, right? I'm not sure if you guys have heard of Spiva. They release basically this performance of, Indian mutual fund and how they have underperformed or overperformed the benchmark. I guess this data is as of June 24, and I think they do on a 6 month. This would be, yeah, no, it has all the returns. So, okay, how you rate this is that for each of the mutual fund categories, so Indian equity large cap, so all the large cap here, ELSS here, mid and small cap here, composite bonds, government bond, okay. And you have 5 bar graph, each represents 6 month, 1 year, 3 year, 5 year, 10 year return. Okay. What they say is that basically all the active funds. So there are two kind of fund. One is active fund, one is passive fund. Active passive fund are basically tracking the benchmark. So if you are a large cap mutual fund, the large cap benchmark is what you will track. So whatever is happening in to the benchmark, whatever new stock are coming in, going out of the large cap benchmark, you will track that. So your return will also track the large cap benchmark. That is passive fund. Active fund are the fund manager says that, look, I can do security or sector allocation such that I will beat the benchmark. I will give more returns than the what the benchmark is giving. So they try to deviate from what the benchmark is doing, right? So benchmark, basically, how is Nifty 50 calculated? So Nifty 50 has, say, 50 stocks, correct? Each stock has some weight, and using that weight, you get the value of the Nifty. How is that computed? Weight? Anyone has idea?
May not be like totally depending upon the market cap, but a market cap may be one of the factor in deciding the weight.
Correct. So market cap is actually, if you think of it, market cap, which is also called as free float. Free float is nothing but all the securities of that company available for trading publicly times the price of the stock is free float. So it is weighted average of free float of each of the 50 stock. So if HDFC has say 300 crore, I'm just making up some numbers, and say Reliance has 500 crore free float. So basically here what is happening, and say some other company has 200 crore. So total is whatever 1000. So 30%, 50% and 20% is the weight. So it's nothing but the weighted average based on free float. There are some other parameters in terms of liquidity and so on, but the major chunk of deciding is basically the free float. So using free float you get the weight. Similarly, all the benchmark has some methodology of how the weights are derived. Now that benchmark, how that is performing versus the mutual fund, how that is performing. The comparison of the two is what this graph is showing. Basically, it says that, and we are talking about only the active fund, passive fund. So because passive fund we know kind of tracks the market, so the underperformance might not be very severe. But all the active fund which says that we will try to beat the benchmark, they are significantly underperforming. So you can see on a longer time frame, on 10-year, the large cap has underperformed by 30%. On 5-year basis, it has kind of almost same as benchmark. For a shorter time period as well, it has underperformed by roughly 20 to 30%. ELSS has consistently underperformed. Same as with mid cap, small cap. Bond are still comparatively better than the equity. But here you can clearly see that mutual funds, and particularly the active mutual fund, are not able to beat the benchmark. And the benchmark here is the market, because for large cap mutual fund, the large cap benchmark is the market for them. So this kind of says that actually market is efficient, and all the fund managers collectively, because this includes all the fund houses, right? They are not able to, on average, they are not able to beat the benchmark. That means that market is efficient. Clear? Any question on this or in
Sir,
this?
one confirmation. So this is an argument in support of EMH, right?
Yeah. So this is saying that market is efficient.
Yes, sir.
The other argument is that there is arbitrage. There is no arbitrage, right? So we know that you can trade equities on NSE, BSE. That is purely from stock point of view. If you think of options, within options you can create a synthetic futures by combining call and put, and you have futures also trading. So all this, buying on one exchange, selling the same stock on the other exchange for a higher price. So say if a stock on BSC is available at 100 and the same stock on NSC is available at 105, you can buy on BSC and sell on NSC, correct? The same stock. But this difference is, you might have a difference, but the difference would be so small that tax and transaction cost would ensure that all the profit that you make is gone to either government or to your broker. So nothing is then kind of left for you. But more importantly, that you will see that although both has their own process in terms of how the bid ask book work, they are still efficient. Both are different exchange, both has their own trading terminals, but you can see that the price of the same stock on two exchange are moving in close coordination, and they are not deviating from each other significantly. If they are deviating, The market participant are coming and capturing that arbitrage, and as more participant enter and capture it, the deviation will reduce, and then again it will be back to parity. So this itself kind of says that market is efficient, right? The same argument applies on the options, futures, and the synthetic options. Even there, if you create a synthetic option, synthetic futures using options and try to capture the difference with the actual futures, you will see the difference is always very small. There is no pure arbitrage available in the market. If they are, I'm not saying it's not completely available, it is available, but the taxes and the transaction costs are so high that you will not actually, even if you see that there is an arbitrage, you might not actually be willing to capture that, because the net profit that you get from that arbitrage would be very small. So even this argument kind of says that the market is indeed efficient. But there are also cases where the market, there are also the examples where you can say that actually market are not efficient. So I guess everyone knows about 2008 crisis, right? And there were few investors, or few hedge fund who were actually able to make good amount of money by shorting the market or buying the protection on those CDS. I guess if you look at this one, I think these two are still okay. Warren Buffett again, his fund has consistently outperformed S&P 500 over decades, right? So although here we said that most of the mutual fund are not able to outperform the market, there are very few who are actually able to do that. Okay, this too might be a weak argument, but this one is important. Here what we are saying is that, and this you can try yourself as well. And by the way, this is based on actual Nifty data. So what I did is basically at the turn of the month. Okay, what is turn of the month? Basically on the last trading day of the month, you buy the stock. Okay, the first day of the next month, the second day, and the third day. This 3 days typically has a positive return. This data I think is over 10 years. What we see is that on an average, the first day of the month, the return was roughly 0.3. The second day, the return was 0.2. Third day was lower, but all the rest of the days are basically very close to 0 or 0.1. So clearly you can see that the first day of the month has a positive return on an average over a longer period of time. If this is the case, then basically it's not efficient, right? It's a market anomaly. Are you with me on this?
Yes, sir.
Yes.
Okay. So yeah, the weak, semi-strong, strong. Actually, there could be few examples which are for the it can be for or against depending on what data you are looking at. But there could be various examples. I have kind of used only few, but there could be various examples which are for and against of efficient market hypothesis. Okay, so with that, what we will now look at is basically now we will start looking from portfolio point of view, whether investor is kind of willing to invest, not willing to invest. Once the portfolio is done, how do you perform a comparison, or how do you evaluate the performance of the portfolio? That is what we will look going forward. And this entire thing or the entire process is based out of you know this guy Markowitz back in 1950. He got Nobel Prize for this as well. Basically, the entire financial economics, I think, is based out of his theories. We'll look at few of them today. The key one is here, the risk averse investor. Basically, what it says is that typical investor are risk averse. Okay, what is risk averse?
Meaning they can avoid the risk by diversifying their investments, or focus on portfolio which could yield results irrespective of volatility.
Correct. Yeah. So they try to
The
avoid
tendency to, yeah, exactly, tendency to avoid risks.
avoid risk. Yeah. So there are actually three types of. You can classify investor into three types: risk averse, risk neutral, or risk seeker, or risk lover. Right. So most of the investors are assumed to be risk averse. Okay. We'll see some of the examples how they try to avoid the risk. But basically here the modern portfolio theory says that once you identify the risk uh, in the securities, you construct a portfolio such that you expect some return for a given level of risk. So there is a whole universe available for investment. Depending on what risk level or what securities you select and the associated risk of that, you expect maximum possible return out of that portfolio. Now, to construct this framework, there were few assumptions that were made, right? And obviously, all these assumptions are not necessarily true. So the key ones are investors are rational, okay, and they behave in a manner as to maximize the utility of the money. So first thing is, are the investor rational? Do you think investors are rational?
Not 100%.
Correct. So depending on situations, right, investors might behave irrational. They might make bad decisions. This typically happens again during severe environment, severe stress environment. We talked about 2008 crisis, the COVID crisis, right, where there was a fire sale happening in the market. People making irrational choices in terms of selling the investment. So although for most of the time the behavior is rational, but during some times or during some situations, you might see that investor actually behaves irrationally. Market are efficient. Again, this goes back to our efficient market hypothesis. Okay, this also might not necessarily be true. Investors are risk averse. Okay, investor would want to maximize return for a given level of risk. Obviously, for a given level of risk, you will require certain returns, and all information is freely available. Again, not necessarily true, because we know that has been many cases of insider trading happening, right? So say if you have this portfolio A and portfolio B, the expected return, okay, is 8%, 12%, but the standard deviation is 10% and 20% on this two portfolio. Which of the two portfolio do you think is better?
A.
Yeah.
A.
Okay. Why do you say A and why not B?
Lesser risk in portfolio A.
Lesser risk. Okay. Any other?
Portfolio, the standard deviation got doubled, but the return was not, doubling terms as far as return is concerned.
Okay. So, sorry, who answered that? I missed that.
Sumant, sir.
Sumant. Ah, okay. Sorry. Sumant, so do you think the standard deviation and the returns can scale in same proportion? So if you are saying that the standard deviation doubled, the return should be 16% for this to be equivalent, correct?
Yes, sir.
Okay. What if standard deviation is 50% on a portfolio, let's say C, the expected return is say 30%. There is a portfolio D, if the standard deviation is 100%, do you think the expected return is 60?
Somewhere intuitively, I don't feel so. But for a
Yeah,
neat
because
comparison, I felt like why portfolio is performing better because its return per unit of risk is better.
yeah, that argument, okay, that is something which is, correct. The return per unit of risk is higher for A than as compared to B. But this thing that you mentioned, right, the doubling part is
Yes,
not true because standard deviation doesn't actually work that way. Standard deviation follows something called as root T principle.
okay.
Okay, so I guess we'll come to that
Actually,
maybe.
yes.
Yeah, so I mean, doubling is not the way that you look at least when you are looking at standard deviation,
Sure, sure.
because standard deviation is basically based on square root. We'll let's park that for now, but just be clear that you can't do a like to like comparison, by doubling or looking at the same ratio basically. So per unit of risk, okay, portfolio A might be better than portfolio B, but that is not necessarily true. The utility that you derive from portfolio A and portfolio B can be different. So someone who is, say let's say portfolio A and portfolio C, I think the values are too high, but let's assume that portfolio A and portfolio C. Again, you might say that portfolio A is better, but the utility that you derive from investing in portfolio A and the return that you get compared to portfolio C might be lesser. And what is this utility that we are talking about? So, or maybe let's put it another way. Say if there is a person whose net worth is say 10 lakh, okay, he gets a return of say 50% during a year. So his 10 lakh investment or his 10 lakh asset net worth becomes how much? Say he earned 5 lakh, so 15 lakh, right?
Like,
Now if there is a someone who is earning or whose net worth is say 100 crore, and if he earns this absolute 5 lakh, the utility that he or the satisfaction that he derives by this increase in 5 lakh, will that be as high as someone who has a net worth of 10 lakh?
No.
So the return, so the central idea here is that the risk and return, the utility that you derive out of the return for the unit of risk, can be different for different investors. And that brings us to the concept of expected utility. Okay, so the decision of making a choice between two portfolio is based out of the utility that you derive out of that decision that you make. I said that most of the investors are risk averse. So uh, say if you are given a choice with a certain return or certain amount that you will get versus a risky return, and here risky is that it might happen, it might not happen. Given this two choice, a risk averse investor will mostly prefer a certain income or certain outcome as compared to an uncertain outcome, although the expected value of uncertain outcome might be equal to the certain amount, but he will always try to get the certain amount instead of taking the risky bet. That is what the risk aversion is. Nunciation is basically you prefer more wealth to less. Okay, this part I think is okay. Diminishing marginal utility of wealth, I guess that all this you can understand as we see the graph. So this, I guess, okay, until now this is clear, right? That this choice actually depends on how much utility or how much satisfaction that you derive out of this would dictate your choice. That is what the utility is all about. Now it will be different for different investor. Like I said, there are three kinds: risk averse, risk neutral, and risk lover. So risk averse are basically something like this. Say if there are returns here and there is a utility here, they will have something like this, a diminishing marginal utility. For every increase in wealth or return, the satisfaction that you get will keep on decreasing. So going back to the 10 lakh thing, right? So a person increasing his wealth from 10 lakh to 15 lakh would get a very high satisfaction, right? His utility will increase by this much. But someone going from here to here, in absolute term, if it's same 5 lakh, his utility is actually not increasing significantly. The utility increase here is small. So that is what happens with risk aversion. Basically, the function is a diminishing as you go higher.
Sir,
This,
clarity, just I'm asking. So we are considering absolute amount, right?
yeah,
Not the
yes,
percentage. Yes.
yeah. Now this as compared to someone who is risk neutral would have a line which is like this of 45 degree. So every increase in wealth or return would give him the same amount of increase in his satisfaction. But the risk lover would have something like this. Okay, which is a convex. So from going in terms of wealth, going from here to here, the utility, increases significantly as the wealth keeps on increasing. This are basically, someone who loves gambling. Maybe I guess I have the examples here. We'll look at that. But before that, let's do this. Let's see how you can actually identify whether you are risk averse, risk neutral, risk lover kind of person, right? And this is used by financial planner. So there are risk assessment done. So if you go to any professional financial planner or investment planner, right, they will give you a questionnaire. Have you guys seen or experienced those kind of questionnaire? No? Okay. So what happens is that they give you some set of uh, questions. It can be something like this, what we are seeing here. It can be situational kind of questions. There are predefined templates available that you can use, or you can see it online as well. But basically what happens is that there are set of questions given to the investor. Say if I am financial planner, I am trying to assess what kind of person you are, right, in terms of your risk aversion, or what is your psychology towards taking risk. Once I understand that, then I can recommend what asset class you should invest on, or I can design your portfolio. If you are someone who has a high tolerance towards risk, I can suggest you some risky asset which can potentially give you a higher return. But if you are someone who doesn't like risk, I will not recommend you some risky asset like say small cap, right, or real estate. So understanding the risk tolerance of the investor is important. So, and how you do that, there are various methods through which you can do that. I'm just giving you a very high level, idea of how it is done. So this is one of the, question that is asked in those questionnaire, and we'll use this information later on as well. But so if you are giving, if you are given an, uh, okay, so if you have an opportunity to invest in a lottery, okay, the lottery has a 50% chance of winning 150K, or winning only 50K, right? How much will you pay for this lottery? Or let's say how much maximum you will pay for this lottery, because if you are paying 100K, then you can might as well pay 90K, right? So the question is how much maximum you will pay to enter this gamble.
100.
Neutral will be 100.
Okay, 100. Anyone else?
80.
Okay, 80.
90.
So 191. Okay, anyone? Anyone will
80.
pay 110?
80K.
Okay, so those, no one, I guess no one for 110K, right? So let's clear this. Why not 110?
Because expected value itself is coming to 100.
Correct. So this has like negative return, right? The expected return on this itself is 100, which is 50 of 150 and 50% of 50 is 100k. So the expected value is 100k. Why would you pay higher than that if you know that your return would be lesser than that? Those who select this are basically risk lover. Who will select this will look at that. But now someone who said 80 as compared to 90 or 100 are basically those who actually don't like risk. They are happy to settle at lower price if your expected value is even higher. 100 is basically someone who is risk neutral. They are paying the fair value or the fair value based on the expected return, and these are basically risk neutral. These are risk covers. So let's see how this three, risk covers, risk neutral, risk seeker, would derive the utility. So going back to say our example here, and this line is the utility that you get for the return on the investment. So what we said is there is a 50% chance of 50k return, 50% chance of 150k return, right? The expected value of this gamble is how much? 100k, correct? So this is the expected return. If I plot this and check how much utility I'm getting, it is this line. So this is my expected utility on the investment or on the gamble. But actually it's not certain, right? Is 100k certain in this gamble? You will have to do that for n number of times so that your expected value becomes close to 100k. So actually it's this line, correct? And 100k kind of crosses here. So your utility is this value. The utility that you derive by doing this gamble is say E1, but depending on your risk aversion, you would have expected a higher utility, which you don't get in this gamble. You get the same utility for a lower price, which is basically 90k. So this line crosses your expected, your utility graph at 90k. The expected return on the gamble is 100k. So what it says is that for this gamble, which is 100k expected return, you will settle for 90k. And that is what I guess some of you answered, right? That the utility that you derive by getting a certain 90k, a guaranteed 90k, is same utility as you get by doing this gamble. Basically, you are ready to let go this 10,000 profit. And this 90k is called as certainty equivalent. Basically, it says that what value are you ready to take to give away this gamble? So what certain values you are ready to take to avoid this uncertainty. Is that clear or?
Yes, sir. Sir, I have
Uh,
one more doubt. Yeah, please, Kapil, I think you can go, please.
no, no. Actually, I was just saying that it's not properly clear. Actually, and, this concept is not getting.
Okay, so we are talking about risk aversion, right? Risk aversion, like I said, is avoiding risk. Then we said that risk averse investor are ready to let go something to avoid uncertainty. Okay, and how do you quantify that? That is by looking at the utility it derives from the investment. So this gamble of 150 50% chance or 50% chance, we everyone agrees that the expected return on this is 100k. So the utility that you will derive by doing this gamble is E1, right? Which is the line that intersects here, and which is basically the point here, E1. This is not same as the wealth when you have 100k in your portfolio. This line actually says that you are ready to let go this gamble and take 90,000 instead, which is 10,000 lower, and settle for that. This 90,000 will give you same utility or same satisfaction as this gamble of 150k and 50k. So since you are happy to take a lower amount as compared to the expected amount on the uncertain event, on the uncertain gamble, you are letting go this 10k. So as long as your this certainty equivalent is lesser than the expected return, you are called risk averse because you are avoiding risk at a cost of something, and that cost here is 10,000. You are letting go this
Okay, got it, got it,
10,000.
sir. Thank you, sir.
Okay.
Sir, one more question.
Yep.
Sorry to interrupt. Sir, can you please go to slide 22 once, if you don't mind?
Mhm.
Yes, sir. Here, that thing was actually somewhere eating my mind. So this root T, which is related to the time, right, sir? T means.
Yeah, time. Yeah.
So if I take it as, suppose portfolio A and B are similar in all the terms, right? The frequency at which standard deviation is calculated and return is calculated is also same. Then 8 is to 10 must be same as 16 is to 20. Then only they become indifferent. Otherwise, we'll choose either of those. And I mean in a particular time period, not like over different time periods.
Okay. No, so I guess my point was on doubling of this.
Yes, sir.
So here, I mean, see, from pure return per risk unit, portfolio A is obviously better, right? But what we are trying to see is that there could be some investor who would actually prefer higher risk, higher return, and not make a choice of portfolio A, which is, higher in terms of per unit of risk. Who are those
Understood.
kind of investor? That is what we are looking as part of this three thing.
Understood, sir. Now it got connected. Understood. Understood.
So this was risk averse. Now there are something called as risk neutral, right? Like I said, it's a straight line. They don't care how much ever they risk take is the same amount of utility that they derive. It's basically a straight going line. If they make 100k, the utility is this much. If they make another 100k, is again the same amount of utility that was there previously. They are indifferent to risk. Now, risk loving or risk seeker investor has a completely opposite of risk averse. So the same example. Now here, the the utility from the gambling is basically here, right? Which is the average of 50 and 150. So the utility that they derive from gambling is UG, which is this. And since their utility function is something like this, which is upward sloping, if you give them a certain 100k, they might actually feel less satisfied. So given a choice of this gamble and a certain 100k, they might actually choose gamble and expect to make 150 and close the game there and walk away with 150, which is higher than 100. So those are basically risk loving or risk seeker. There are very few actually who are risk seeker, or those who are kind of addicted to gambling are more of a risk seeker than uh, the the normal investors.
But sir, what is the point of getting into 110 when the expected return on this is 100?
Okay, so let me put it this way. Um, yeah, okay, I think I had one example. So anyone knows about this lottery system? I guess it's very famous here in India, right? Kerala state has their own lottery system. Anyone knows about it or have any friend, family who kind of do this? No? Okay. So I'm not sure if you guys know, but basically Kerala state government, they have this lottery system which they think is a better way to tax the citizen. Okay, I guess I will not go into the structure of how the lottery works, but let me just find one example I had with me. I'm not sure if I have saved it. Let's check. I guess so. Yeah, this one. Okay, so they publish this on a daily basis, but there are various structure of their lottery system. I guess some 6 7 systems or different uh, prizes that you get on buying this lottery. Let's not go into that. I'm just trying to answer the question that you raised, right? Who are the people who will actually pay 110 if the expected value is 100? Those people I said are people who likes to gamble. Who likes to gamble? Who do you think are the people who likes to gamble?
people who have very huge chunk of capital, it's like we can even if they lose some amount, it's okay for them.
No, actually it's other way around. It's the people who are, you know, below a certain level of wealth, who wants some miracle to happen and lift their, you know, uh, poverty and basically reach some level. Yeah. So maybe let me quickly show you this, right? So this is the lottery system. One of the categories win-win, and basically what they do is they sell roughly 1 crore 8 lakh tickets. Sorry, each ticket is of 40 rupees. Okay, face value GST, let's leave that aside. The prize money you will get is basically 75 lakh for one ticket. For the first prize 5 lakh, then this is how much, 1 lakh 12 people will get 1 lakh, then they will have 5,000, 2,000, 1,500 and 100 for this many. For, you know, last four digit is matching, then you will get 5,000 rupees, and there could be 19,440 tickets who can get this price. Okay, so if you look at the total of this, what's happening is we get 75, 5 lakh, 1 lakh, 5,000, 2,000, 1,500, 100. Consolation prize is 8,000. Okay. How many people will win this? 1, 1, 12, 19, 440, 10, 800, 15, 120, 88, 560, 13, 60, 80, and 11 people. Sum of this is how much? So there are roughly 2 lakh 70,000 possible winners, right, with different price. Uh, so yeah, okay. And what we are saying is there are roughly 108 lakh tickets sold. Now, I know that, you know, this is something which is not always true. They are not able to sell all the tickets. So if they are not able to sell all the tickets, then the prize money also changes. There is some mechanism there. But let's assume that, you know, all the tickets are sold. So now tell me, what is the probability of you winning 75 lakh? 1 divided by this, correct? So these are the probabilities of you winning this prize amount. What is the expected win, or, you know, probability adjusted win? So this is the total win expected for each of this prize amount. And when you add this together, what is your net expected value? 18 rupees, right? Your expected value or expected win on this lottery system is 18 rupees. You have to buy this by paying 40. The price of each ticket is 40. Your expected win is 80. This goes back to our this investor, right? The expected win for him is 19, but he is paying 40 rupees. So it's not that, you know, you will not have this kind of invest.
Okay.
There are basically, like I said, these are people who likes to gamble, who will buy lottery. They will have a very high expectation of winning by using some lucky number, or, you know, any form of uh, you know, way through which they think, or their mind think, that they will make bumper amount, and they will buy ticket and keep on buying ticket, right? But we can clearly see here that the expected value is less than the money that they are paying. So those kind of investor would have this kind of graph. Does that answer?
Yes, sir.
Okay, cool. Sanjay, I don't know answer to that. Why can't I honestly, I think this should not be encouraged. I mean, see, the target audience for this lottery system are people who are below certain level of income, right? I don't think this should be encouraged, because it's a net loss making proposition for those people, and they are anyways below a certain level of income. I don't think this should be encouraged. But it's a very good revenue source for the government. You read about this. I think the Kerala government has been doing this for over many years. I think they are actually making good amount of revenue out of this. You can clearly see here that the overall collection they make. I guess they have it here itself, right? So they collect 33 crore by selling the ticket. The prize amount is 20 crore. It's a clear cut 13 crore profit for them. Why would not they do that? And the argument that they do is that they are able to provide employment, because these are sold via small shop which are situated at bus stop, railway stations, with a small stall, and they sell. Many people actually sell ticket and they earn commission. Yeah, I guess even commission is like good. If you sold a ticket and your ticket has won the bumper prize, you get a good amount as a commission. So yeah, I mean, the argument they do is that we are generating employment and generating income for small people, but I think it's also kind of detrimental to the investor or those who are gambling. So it's kind of addiction for them. Okay, now coming back to uh, let's complete up to here. So coming back to utility, right? So all this thing, like I said utility, but I didn't quantify the amount. How much utility? Did I quantify that? We just talked about utility in relation to each other or in relative term. So to quantify a utility, you have a utility function, and the utility function is nothing but the expected return minus half of variance, okay, times A. And what is A? A is the quantity of risk aversion, or a coefficient of risk aversion. How risk averse are you will be quantified with A. Expected return is known. Variance is also known. When you plug this, figures in this function, what you get is the expected utility. So to give you an example, say there is an investor who has, the coefficient of risk aversion is 2, and he is given a risk-free asset which gives 5% return. The utility is simple, right? 5% minus half of variance into A. What is the standard deviation of risk-free asset? 0, right? Because it's risk-free. There is no risk. So the standard deviation is 0. This entire term is 0. So basically his utility is same as the risk-free return, which is 5. So once you have this, right, then you can derive how much would be your expected return. How much should a investor with A equal to with a risk aversion coefficient of 2 should expect the return when the standard deviation is, say, some percentage, say y%. You can now plug this input in this formula. You know the utility is, this 0.05. You can derive the expected return. So for this investor who is happy to settle 5% risk-free return for a asset which has a risk of 10% or a standard deviation of 10%, his expected return would be 6%. How 6%? So utility is equal to the expected return minus half of variance times the risk aversion coefficient. So with this formula, you get the expected return when you have a risky asset of a 10% standard deviation. You expect a 6% return on this asset. If I do this for 12%, right, I can get the expected return again with the same utility. So if for 10% is 6% return, I can do for 12% as well, right? For a 12% risky asset, I can find this. For 14%, I can find this, and so on. So putting this various standard deviation and the expected return on a graph gives you the indifference curve. So indifference is basically you are indifferent between two investment choice. So let's first understand, what this indifference curve is. So on a risk, which is standard deviation, and a return graph, right? And okay, let's say something like this. So what we are saying is that for this amount of standard deviation, you expect this return. For this amount of standard deviation, you expect this return. So if you are given choice of portfolio A and portfolio B, you are indifferent to choose between A and B because it's giving you the same utility which we saw here, which is 0.05. So indifference curve tells you that any portfolio on this curve, you are indifferent in terms of utility that you derive out of that portfolio. That is what the indifference curve is. We saw three kind of investor, right? Risk averse, risk neutral, and risk lover. So the graph actually would be different depending on, what those kind of investor. So clearly risk lover has a downward sloping, something like this. Risk neutral is straight line, right? They are indifferent of risk. Within risk averse, there could be variations in terms of, how risk averse you are. Are you very high risk averse or low risk averse? High risk averse mean you are very, you don't want risk. Basically, you try to avoid risk as much as possible. Low risk averse is you avoid risk, but you are okay to take, certain amount of risk to a certain limit. So those are low risk averse. Now, in terms of the graph, if you look at the graph, for every increase in standard deviation, right, or every increase in risk, you need to compensate with a higher return for a risk averse investor. But if someone who is low risk averse is okay to take on more risk with a very smaller increase in expected return. So between this two graph, you can see that the line 3 is someone who is happy to take on more risk even for a smaller increase in expected return. Risk averse is someone who is expecting a very high return for every small increase in risk. Clear, or any question on this?
Sir, related to that risk lever, actually, can we say it as a person who chooses 110K or something in our example? Like
Yes, that
expected
was
wise, they're
100K.
actually at loss. When we talk about expected wise, they will be at loss, but they're ready to take it because they have high expectation on the higher end that can happen.
Yeah, so correct. So that is why I said, right, that no one in this batch or from us was happy to take this, because we all know the expected return on this was 100K. But there might be someone who would not understand this concept, or even if they understand this concept, they might be greedy to get this, right? They know that there is a 50% chance I will make 150K. As soon as I make 150K, I will go away. That is what is happening in the person who is buying the lottery as well, right? Every day he will keep on paying that 40 rupees until he earns that 75 lakh or 12 lakh, whatever that amount is. So basically, in terms of expected return, will always be lower than the cost that you are paying. So that 110K, someone who is choosing 110K is basically the risk lover, or someone who is buying those lottery ticket are basically these guys.
Yes, sir. So the thought process would be in that direction that this expected is over some time, but maybe the very next case might be the case where it might be 120 or 130. So why not let us try it?
Yeah, yeah. So they might think, I play this for 10 times, right? I might pay, maybe 5K, 7K, but if I get 150K, or the expected value is more than 100K net of the cost, then they are happy with that. Yep.
Yes, sir. Understood.
So yeah, those are risk lower. So this is how the graph would look like for someone who are risk averse, which is upward sloping in terms of expected return and standard deviation space, and straight line for neutral and downwards for lower. Now, eh, as I mentioned, any point on this graph, the investor are indifferent. He might choose this or this or this. Is indifferent because his utility derived from this entire graph is same. So if you look at the right side graph, if he wants higher utility, he will have to travel northwest. Basically, the graph will go towards up and left. So this is like the low utility, right? If he is expecting higher utility, he will have to travel upward. Basically, higher utility meaning higher return for same amount of risk. So if I plot a risk here, with this utility, I am expecting, say, Y return. But with a higher utility, I'm expecting a Z return, which is above the Y. So for same risk, higher return is basically higher utility. So as you keep on, expecting higher return for same risk, your utility is obviously increasing, but then it also goes towards not something which might not be achievable. So, beyond certain point, you might not get the expected return for the same level of standard deviation, because that's not possible in terms of market giving you that return. Okay, is this clear? The indifference curve, we'll be using this curve again later on. Let me know if something is still not clear in this. Okay, let's maybe take a break here.
Sir, any general statement or relation if we can identify between return and standard deviation, if possible?
Um, do are you asking in terms of ratio? I mean that if,
In terms of yeah, a proportion or that way.
okay, there is other way to look at it. You actually you can evaluate the performance with in comparison to risk by using various ratios like Sharpe ratio, Treynor ratio, Sortino ratio. That is basically comparing the risk and the return and looking and basically identifying which has given a outperformance as compared to others. We'll see that I think tomorrow. But it, that again is like looking at return in comparison to risk. I don't think there might be a direct way to generalize the return and standard deviation, because see each asset class would have different relation, right? So bond, we know the standard deviation is lower, return is lower. Equity is very wide. Higher standard deviation, return can
So
also be
we
high.
can look at these plots, but we cannot generalize it into a statement.
No, so yeah, let me maybe clarify this, right? So indifference curve is unique to everyone. Your indifference curve might be different than my indifference curve. Your risk aversion might be different than my risk aversion or to any of these 23 participants we have here, right? Each of us might have different risk aversion, different utility that we derive. So all this is in the back of what I asked here, right? That which of the two portfolio is different, better. For me, might be portfolio B is better depending on my risk aversion and my utility. So basically, this entire theory says that you can't actually generalize this in terms of everyone would have same portfolio choices. Everyone can have different portfolio choices, and those are dictated by this graph here, which is how risk covers are you and what utility you derive from
Okay, sir.
it. Okay. Let's take another break. Are you guys up for break, or do you guys want to continue?
Sir, if we can continue and like wrap up the lecture early.
Uh, okay. Yeah, I can do that. Are others okay with it? I can actually do that.
We could do 15 instead of 20 or 30.
Yes, sir.
Okay. Okay, then it's 6:55. Let's come back at then 7:10 maybe. Yeah, let's come back at 7:10.
This conference will now be recorded.
Kapil, what do you mean by start the slideshow?
Actually, when you can click on the you know, or you can press the F5 button. So this slideshow is
Oh, okay, okay. Okay, I thought you were talking about better now.
yeah, it's better.
Okay, is that very small? I mean, in
Because normally a laptop screen is very nowadays smaller, so it is again very small if you show less slides like that way. So
okay.
now it's better.
Yeah, the only problem with this is that I won't be able to draw something.
Okay, then no problem, sir. You can select.
Maybe
That
let me save
it's
this
better.
as PDF, I guess.
So we'll upload this presentation on LMS.
Yeah, yeah, yes, yes, yes. So I will send it to Nitish today itself. Uh, I I don't know when they normally upload on LMS, but yeah, it will be there on LMS.
That's better now.
Okay, cool. Let me use this then. Is there a drawing tool? Ah, you have it here. Okay. Okay, so let's start. We were, yeah. So, okay, I think this kind of covers a lot of theory, right? Now let's do some practical stuff. Going back to, the question that I asked. Now let's say there are four portfolios, okay, with various returns and various risk. And now we know the risk aversion. So say A is 4 for, say, investor A, and for investor B, the A is 2, right? Now tell me which of the four portfolio is better for A and B, or which of the four portfolio will they choose now? How will you go about, solving this? So we need to use this, right? We need to see how much utility they derive for each of this portfolio. So can can you guys, compute utility for this 8 cells? Maybe quickly do it in Excel, or you can do simultaneously as well. So what we are saying is, so what we are saying is we need to first find the utility for each of this, right? Using the utility function, which is nothing but expected return minus, so expected return, come on, expected return minus 0.5 times A times the variance, correct? Let's quickly do that. So expected return minus 0.5 times A is 4 here, right? let's do this, and then variance which is 20% square, and this is 4. So this are the utility for investor A. Similarly for B, the utility is 2. Now which one would A select and which one would B select? You got the utility, right? I guess the answer is clear now. I hope the
First
question
one
is,
for yeah, first
yeah,
one for A and second one for B.
second,
Third one,
Sorry, third one. Sorry.
third
Third
one,
one.
yeah, yeah. So now you see that, for per unit of risk, let's see what's the per unit of risk. Even if, the per unit of risk is higher for portfolio 3 as compared to 1, investor A will still choose 1 over 3 because he derives a higher utility from portfolio A. And why is that? Because investor A is more risk averse than investor B. He would dislike, investment 4 because of the high risk. See, try to remember this. A very high risk averse investor would require a very high return for a small increase in risk as compared to low risk averse investor. The utility, the A of 4 is basically higher the A, higher the risk aversion. So A4 is someone who is very risk averse as compared to A with 2, and for that reason he would actually prefer this over this. Is that clear? Or
So can you explain it again? Why 1 and 3?
so okay, so individually for A, investor A, out of this 4 portfolio, he will choose the one which gives him the maximum utility, correct? Based on this indifference graph that we were looking at. Now investor A has the maximum utility for portfolio A, which is at 4. Investor B has a maximum utility for portfolio 3, which is at 12.
Okay, sir.
So given various combination of risk and return, expected return, different investor will choose different portfolio based on their utility they derive from the investment. And higher the risk aversion, lower would be the selection in terms of risk for a risk averse investor. Someone who is not risk averse or who has low risk aversion would tend towards selecting a portfolio which has a higher risk. Okay.
But here, as they expect higher returns with minimal risk, so it will be 1 and 3, right?
No, the choice is because of the utility they derive, not in relation to how much return is on or how much is the risk. It's the utility, and utility is basically this function. This function, right? half of variance. This you will understand better as we go into options pricing, because similar concept is used in Black and Scholes model as well. But I guess that's more of mathematical thing. But let's park that for now. If you want to break this function, what it's doing is that what we are saying is utility is nothing but the expected return minus something, right? And that something is A and variance. Zero point 0.5 is constant, right? A says that higher the A, lower the risk I will prefer. Lower the A, higher the risk I will prefer. And that is what is happening here. Basically, someone who is with a high A, which is say 4 in this case, is a risk averse person and he will dislike risk. And for that person, automatically the utility will be higher when the risk is lower. And someone who has a tolerance to risk will choose a more risky portfolio as compared to someone who doesn't have the tolerance.
In both cases, maximum utilities are chosen.
Yeah, maximum utility is correct. Yep.
Okay.
So in both the cases, it be concluded that if the risk is high, the utility will be also high. I mean, we can see that 4 and 12. So the second investor's utility is 12, so he is taking more risk. So is it correct statement?
So I guess the the crux of this is basically the values of A.
Okay.
So the value of A will determine how much weight you are giving to the risk. So if you are risk averse person, you are more sensitive to risk, and that is why this higher value will reduce your overall utility.
Okay.
And sir, actually, it resembles what I have observed is it actually resembles what we have seen in the graph perfectly, right? If you see 4, say it went to 2.5 immediately, when that risk averse person was not able to find
Yeah, correct.
that he's being compensated properly.
Yeah, perfect. That is what I wanted to highlight as well. So this is the investor A in our example, and this is the this would be the investor B. So even for higher risk, it is okay to settle for relatively smaller increase in return. A, who is very risk averse, he wants higher return, then only he will take higher risk. Otherwise, he will not take higher risk. Okay. Now tell me if you are risk neutral. This was for risk averse, right? If someone who is risk neutral, which of the four they will choose? Remember, risk neutral is, what is risk neutral?
They'll have horizontal line.
Yeah.
A0, raised to 0.
Will they choose 1, 2, 3, 4?
They'll choose portfolio 4 because
Okay, 4.
they won't
Fine.
have any relation with the risk. Right?
Correct. So they are not concerned of risk, right? I mean, they are indifferent to what level of risk they are taking. So obviously they will choose the portfolio with highest return, which is 24. They will not look at risk altogether. Okay. So I guess this was, based in terms of portfolio selection. Now let's construct a portfolio. Okay. And We'll go this, step by step. So the first thing we'll do is we'll take two asset portfolio, of which one is risk free and one is risky, right? And then second one we'll take is both risky portfolio, and then third one we'll look at is multiple portfolios, multiple risky plus risk free portfolio. We'll go step by step. So first let's cover this. Given two asset, right? Risk free asset and one risky asset. And risky asset can be a portfolio or a single stock, anything, right? But there are two asset only, or two instrument. If there are two instrument, risk free and risky, given the return and standard deviation, you can plot something called as capital allocation line. What is capital allocation line? It basically is all the combination of weight between A and B. Here A is risk free asset, B is risky asset. All the possible combinations, so 0 and 100%, or 10% in risk free, 90% in risky, or 90% in risk free, 10%. There could be multiple possible combinations, right? All the possible combinations plotted on the standard deviation and the return space is nothing but the capital allocation line. So let's do that. So we said, you know, let's call this risk free and this is risky asset. Okay. So return on risk free we know is 6% for say Indian market, correct? Risky asset, something like Nifty or any equity, with a 15% return and a standard deviation of 25%. And these are the weights. The weights that you will assign to this and this. Obviously the sum has to be 100. And these are, all the possible combination of the portfolio. So we are taking roughly 11 portfolios. Obviously you can do multiple, but let's stick to rounded numbers. So what we are saying is you will put 0 weight on risk free and allocate 100% to risky asset. If I do that, how will you compute the return? I'm saying you have two asset weighted average, right?
Yeah.
So some product of weight into the return. If you put 10% in risk free, 90% in risky, again some product, right? The weighted average of return. I guess this is straightforward. Now, how will you compute the standard deviation of the portfolio? So what we are saying is risk free asset has 0% standard deviation. Risky asset has 25% standard deviation. If I put all my money in risky asset, obviously the standard deviation is 25%. Straightforward, right? Same as the risky asset. But what if I put 10% in risk free, 90% in risky? Then what will be my portfolio standard deviation? Okay. What is the, how do you compute portfolio standard deviation? Anyone knows about?
Some of their, square root of, if you calculate variance, it's like some of their weight, summation of weight into their individual standard deviations, plus the how they interact with each other, like the covariance term, roughly.
Okay. Yeah, that's correct. So basically, you take weight square into variance, right, of asset plus weight square into variance of the other asset plus 2 times weight 1 into weight 2 into the standard deviation of 1 into standard deviation of 2, right? This is how I guess I have put the okay, I don't have it. Yeah. So anyway, so basically portfolio standard deviation is weight square into variance plus weight square of the other asset into variance plus 2 times weight into standard deviation into standard deviation. So this gives you the variance. The square root of this is the standard deviation, correct? The square root of the above is basically the standard deviation. Now this is simple to do if there are only two assets, but as you keep on increasing the asset, this terms keeps on repeating, correct? And it's not convenient to do like this. So for the other way of doing this is by doing a matrix multiplication. So if you are doing a matrix multiplication, then it's nothing but uh, the weight matrix times the covariance matrix, right? So the covariance between these two assets and the weight, and weight in form of matrix, and then you again matrix multiply this with the transpose of the weight, and what you get is, sorry, where did that sign go? So weight matrix multiply weight with the covariance, and whatever result you get, again matrix multiply with the transpose of the weight, and what you get is the basically variance of the portfolio, and the square root of that is the standard deviation. If you have a correlation, remember what's the relation between correlation and covariance? So here I am using covariance, right? What's the relation between covariance and correlation? We did that today.
I think it normalizes the outcome values to -1 to 1 in terms of
Yeah. So I'm saying, how do you arrive at correlation?
we by
Correlation is
of 1 into
covariance upon standard deviation of
Individual.
one
1 into
individual.
Yeah.
Yes.
So basically then correlation, or covariance is correlation into standard deviation, right? So you replace this correlation into standard deviation in this formula, and that is why what I did here. So basically I have assumed a correlation of 1, okay, and this is just for simplicity. You can take any value you like.
And sir, how did you calculate the return?
This one, it's
Third
the
column.
weighted average, right? So this multiplied by this plus this multiplied by this.
Okay, sir.
So return is not a problem. It's simple weighted average. So 40 into 6%, 60 into 15% is 11.4%. But when it comes to standard deviation, you need to look at the correlation between these two or the covariance between these two. If the correlation is 1, then it's okay. I think you kind of, it's become simple. But if the correlation is not 1, then while computing the standard deviation, you have to account for the correlation between two. And how you get that is basically you multiply, and talking in terms of matrix multiplication. So how you do is, first you look at this part here. What's happening is O7P7, this is the standard deviation, into O5P5, which is the weight. Sorry, yeah, the other way around. The weight into standard deviation. So this term here is weight into standard deviation. Matrix multiply this with the correlation, this one. So this gives you a matrix which is arrived by using product of this matrix multiplied with the correlation matrix. Whatever result you get, you again matrix multiply that with the standard deviation times weight. And what you get is the variance, and the square root of that is the standard deviation. Is that clear, or?
Yep. Okay. Milan, can you show the matrix form of this calculation? I think it was in the slides. Just to
Yeah, yeah, this one, yeah. But this is, oh, okay, I had it here. Sorry. So this is basically the standard deviation of the portfolio is nothing but the weight matrix times the covariance matrix, which is this 2 by 2, and matrix multiply that with the transpose of this weight.
Excuse me, sir.
Yeah.
Yeah, so this matrix is 1.5.51. Is it defined, or how this,
Yeah,
how you consider?
this mhm. So this I assumed 0.5 for now. You can take any
Okay.
value
Yeah,
you
yeah.
want,
That
but
can vary, right? Okay.
yeah, correct. We'll
Oh,
use the actual numbers when we look at, the efficient frontier. When we look at this one, right, we'll
mhm.
use the actual numbers. But for
Okay, got it.
now, just to introduce this concept, I'm using some hypothetical numbers here.
Okay, yes, yes.
Also, sir, how did we arrive on the covariance matrix?
So we don't have the covariance matrix here. We
Okay.
assume this is the correlation matrix, correct? We have the correlation matrix, we have the standard deviation, we can get the covariance.
Okay, so for now it's just an assumption.
Yeah, this is just an assumption, correct? Maybe, okay, I guess it's too late today. I will try and do one example tomorrow, and we'll see how you basically do this, the covariance, the matrix multiplication, if there are multiple assets. Let We can do that tomorrow before we start. So let's say that I have the portfolio standard deviation, right, for each of this possible weights. So for different weight, you see the standard deviation is highest when when I allocate 100% of my fund to risky. When I assign 100% to risk free, my obviously the standard deviation is 0 because the standard deviation of risk free asset is 0. And the higher the weight to risk free, the lower the standard deviation, right? So now what we have is the portfolio level return, portfolio level risk. When I plot this in a graph, what I get is basically the capital allocation line, which is the blue line here. Correct? Now, this is like, the universe. And I kept on saying the utility that you derive is actually different. Correct? So, let's see for different utilities, the utility that you derive, what is the expected return? So something like this yellow line, okay? And this again goes back to this graph. Try to remember this graph, this one. What I said, if you remember, is that the investor utility would be lower when his expected return is lesser as compared to uh, the other line where the return is higher for the same amount of risk. So for a same amount of risk, if he gets better return, then his utility is increasing, correct? So the tendency is, to go towards top left. If you are able to go towards top left, basically you are able to maximize the return for a given level of risk. And on single line, you can choose any portfolio, because then you are indifferent if you choose A or B. The utility that you derive on A and utility that you derive on B is same. Any point on this line, the utility is same. Any point on this line, the utility is same. But if you compare, the portfolios between two lines, so between A, B and C, you will obviously choose A or B because it is giving you higher return for the given amount of risk that you are taking, which is nothing but a higher utility. When you do this, when you plot multiple utility lines on this graph, so this is like the same 1, 2, 3 we saw there. You can see that the yellow line is basically asking for a return which is not possible based out of this portfolio. And that is why it is not intersecting the capital allocation line. So you will have to reduce your utility. Now, as you reduce your utility, you are okay to settle for lower return. And this line here is basically the line which kind of, is intersecting the capital allocation line. And this is the utility which is possible. You will not, use this utility because you know that there are possible combinations that will give you a higher return as compared to the risk that you are taking. So this line is basically the tangency line to the capital allocation line, and this is the portfolio which will give you the maximum utility, or the portfolio that you will choose. Because this point here, which is 13, this one, 50% in risk free, 50% in risky, with an expected return of 10.5% and the risk of 13% is possible, and you will choose this because it kind of lies on your utility line. You will have to adjust the amount of utility or satisfaction you derive, and you will have to go and find a point where your utility interacts with the capital allocation line. Is that clear? Or yes, no? Okay.
So
So
within the given constraints, actually, we are choosing the best, which can
yeah,
be it
correct.
from our report in
Yeah,
all the aspects. Yes.
yeah. So basically on this line, so what we did is we derived 11 portfolios, and we said, we can choose out of this 11 portfolio any portfolio. We will choose this because it this portfolio is a portfolio which kind of falls on the utility which I can derive on this portfolio, which is equal to 11% or 0.11. And I will not choose this one because there are better portfolio which will give me a higher utility, which obviously falls on this line, and gives me a higher return for a given amount of risk. So basically the point here is to find the tangency portfolio which kind of interacts with your utility, which is basically this point. And this is for a risk averse investor whose A value is 3. His risk aversion coefficient is roughly 3. For the same investor with different utility, this is how the graph will behave. Now, just to change the utility, change the risk aversion, you can also look at the same thing, but now instead of looking at a single investor with a risk aversion of 3, I have two outcomes here. So I have the red line, this one is someone who is highly risk averse, and the yellow, which is a someone who is low risk averse. You will see that high risk averse has a utility line which is tangent to this line at a lower risk return as compared to someone who is low risk averse, who is falling somewhere here. So low risk averse person is ready to accept high risk and expect high return, as compared to someone who is high risk averse, who will take lower risk and lower return from the possible combination of portfolios. We know only something on this line is possible, right? You will select a portfolio only on this blue line. So a high risk averse person will choose somewhere here, low risk averse will choose somewhere here. And that point is basically his utility touching the capital allocation line.
Yes, sir.
Okay. Yeah, this is the same graph. Okay, let's cover this, and I guess we can wrap it up here. So now instead of looking at risk free and risky asset. Let's now look at two risky asset. Okay, and so now we have asset A, asset B. They have some return and some standard deviation. Now both are risky, and again the same possible 11 combination of portfolio, right? We get the expected return, right? But now the standard deviation, or the the risk of the portfolio, can be computed by using different correlation. So here I assume the correlation is 1. Correlation 1 is basically both moving in tangent, right? Sorry, both moving together. So one going up, the other one going up by the equal amount. So if the correlation is 1, the riskiness is also high. You will see the standard deviation would be higher here as compared to assuming a zero correlation between these two. So when you assume zero correlation, you see the standard deviation is lower as compared to assuming a correlation of 1. And if you assume negative correlation, then it is even lower and significantly lower at some point. Okay, so basically here, and why we are doing this is basically to find the boundary condition. So we know that this line is the return when the correlation is 1. This line is the return, the expected return for given risk when the correlation is negative. So actually when you have a negative correlation, you have this two lines going. So this gray line is basically assuming a negative correlation, a perfect negative, -1 is perfect negative correlation between A and B. If you have this kind of correlation, a -1 correlation, the risk return line will look something like this. When you have perfect 1 correlation, you have a return line like this. And what happens is that the and we know that the correlation between two asset is neither 1 nor -1. It is somewhere in between, right? There are no assets which are perfectly correlated as 1 or perfectly negatively correlated as -1. So basically -1, this gray line and blue line is nothing but the boundary condition. This has become your lower boundary, this has become your upper boundary. If you now assume any correlation between 1 and -1, say if you assume 0.5 correlation, then this blue line will fall between this gray and blue line. If I change this to towards negative side, so this will start moving towards -1 as you keep on decreasing its correlation, or it will move towards this blue line as you keep on increasing its correlation. But basically this triangle that is formed is the boundary condition, and the risk and return will fall within this boundary condition.
So, sir, previously we had to find the tangential point and now the boundary points.
Yeah, so here we are trying to find the boundary points and looking at by changing the correlation between the assets. Now this same thing you can apply here as well. You try to find, depending on your risk aversion, any, if say the actual correlation between these two asset is -0.2, then you find a tangency indifference curve like this, and then you should invest in this point here in this portfolio. You can draw different indifference curve depending on risk aversion that you are talking about. Let me check if I have that as well. No. Yeah, but you can do the same thing here as well. But here the idea was to kind of not restrict ourselves to one, assuming one correlation, but to look at how this line would behave when there are different correlation possible between these two assets.
Sir, correct me if I'm wrong. So the whole game is with the aspect that return is always weighted return, but standard deviation is not weighted standard deviation.
No. Yeah, the standard deviation account will have to account for the correlation as well.
Yeah, so that is the actually what that is creating this, maybe for the loss of better words, can I say this arbitrage which we are seeing right now?
Uh, no, I would not call that arbitrage. No? I mean,
I mean,
see,
some
mhm. Yeah, go on.
yeah. So what I was saying is, anywhere in all of these conditions, the return is always weighted return from the formula, but
Yeah,
the risk actually is like it is dependent on the correlation. So if we are able to choose, uncorrelated or something, and able to achieve the same return, so in that sense, I used the word arbitrage actually. So maybe
no,
at the
but mhm.
at the end, it felt like a game, because the formulas are not equally weighted average. The return is always weighted average return, but this is not a weighted average formula for standard deviation of portfolio. Even the covariance term is coming inside that. I will just check on it and I'll get more clarity on it, sir. Actually, and then come back to you tomorrow if I have
Yeah, okay,
doubt.
yeah, but yeah, I guess the point you are trying to make is that the standard deviation incorporates the covariance or the correlation, and basically what we are trying to do here is that looking at what all possible values can this risk return plot take and creating a boundary condition by looking at the extreme values of correlation, which is 1 and -1. Once we have that, and once we know that these are the boundary conditions, any correlation that can happen between these two assets, the risk return will fall in this area.
Yes, sir.
I think we already covered this. Okay. Okay, just one last one. I know we are about time, but and this is important because what we will cover next is kind of related to this. So until now we were looking at two asset. Okay, so what happens when you add multiple asset? We talked about diversification, right? The plot here is nothing but the number of stock you have in your portfolio and the associated risk with it. So if you have only one stock in your portfolio, say the standard deviation is 24%. As you keep on adding the number of stocks in your portfolio, you can see that the standard deviation keeps on decreasing. So that is the basically the benefit that you derive out of the diversification. The risk reduces by this amount, which is nothing but you are eliminating some of the risk. But you can see that no matter how much you keep on adding, the line will then kind of flatten out. The most diversification benefit happens here, right? You can see that the standard deviation has gone down significantly up until here and then it flattens out. By the way, this graph is based on actual data of Nifty constituent. So I randomly picked up one constituent, saw its standard deviation was 24%, randomly kept on adding new stock and checked the overall standard deviation and it kept on going down. So obviously I have only till 37. If I keep on doing this, it will flatten out. And what remains is basically the pure market risk. And this standard deviation is nothing but the Nifty standard deviation. Clear? So as you keep on adding new stock, the riskiness of the portfolio will go down. Beyond certain point, it will not help. And that is why you will see lot of people online, or fin influencer. I am not sure fin influencer kind of understand this concept, but basically the idea here is that over diversification is not useful. It doesn't help. The ideal portfolio, you will see, if you look at some of the literature, right, they will say that the ideal number of stock in your portfolio should be roughly 15 to 20, because that is where you get the maximum uh, possible diversification benefit for a minimum number of stock you add. So 15 to 20% is what you will typically see if you kind of read some research paper. You will see 15 to 20 is the ideal number of stock you should have in your portfolio. Beyond that, it's just over diversification. It's not going to help. Under that is too concentrated positions to have in your portfolio. This also shows that why you should not invest in multiple mutual fund. Each mutual fund would have roughly 20 stocks, right? If you keep on adding mutual fund from the same category, it's not gonna help. It's basically what if you have like all mutual fund across multiple categories. Basically, what you have done is you have invested in all the stock which are available in NSE. That's simply over diversification. How does it help? So here we have the price of Nifty, gold, and the 10-year GSEC. We know how each of them behaved. This is like COVID, the stock fell, the gold also went down, GSEC were up, right? Now, if I invested equally across all these three assets, the yellow line shows that the drawdown I had during COVID is much lesser as compared to if I had only Nifty in my portfolio. So basically, this and gold has also helped in terms of diversification. You can see the daily fluctuation for each of the asset class here, and if you had invested in all three equally, the maximum it went was 4% on during COVID March 23, whatever that date was. But Nifty was down roughly 12%, I guess. So basically here cross asset diversification obviously helps. Okay, I think we can stop it here for today.
So, what was the title of the previous two numericals on CAL that we did? Like under what topic they fall?
This is modern portfolio theory. All
Uh,
this is basically modern portfolio theory.
yeah,
Utility,
the two numericals that you did on Excel.
you mean this one?
Yes, both of these.
So this here we were okay. So if you are asking of this graphs here, these are same utility graph indifference curve. What we did is basically we just added this over and above the capital allocation line. So
Okay,
this,
and if they are important, can we find some numericals like these online?
yeah, I think This is there in the CFA FRM curriculum.
Okay.
Let me.
Sir, if you don't mind, we would just like to experiment with this. You would be sharing these Excels also, right?
Yeah.
Yeah.
Yes.
Thanks.
Yeah, it's under portfolio management.
Okay, so utility functions. Okay.
Yeah, utility. I think this is part of level 1. Yeah, correct. Level 1 portfolio theory, I think. I will be sharing all the materials that we are discussing, including the Excels, and everything we'll cover tomorrow as well.
Okay, sir.
Okay. Any other questions, comment?
I just had one thing. So,
Yeah.
can you go to the sheet that had correlation metrics, four metrics that
Okay.
we had?
Yeah, this one.
Yeah, this one. So the last one, here you have written zero point 0.5 and minus zero point 0.2. Uh, won't they be the same?
Oh yeah. Sorry.
No, okay. This
Yeah, I
is
guess the Excel link was different for different cell. Yeah. Good, you
okay.
pointed out.
I just heard this out.
Yeah.
Thank you.
Yeah. Thanks. Okay. Any other questions, comment? Okay. Tomorrow we might have to rush through, otherwise we might not be able to cover everything. And some important or interesting topics will be on the second half. So yeah, let's try to be on time and then we can start as early as possible.
Okay, sir. And do we need to